Today, the FOMC decided to leave our policy rate unchanged.
They decided to just basically completely ignore the Middle Eastern shock that we're facing here.
They're basically saying all of this going on in the Middle East is a speed bump.
I'm not really taking the SEP or the dots very seriously.
There's not a huge amount of forecast accuracy here.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday, wrestling with escalation. Major energy assets taking significant hits across the Middle East, sending Brent crude surging and fueling another spike in gas prices, leaving President Trump struggling to stop the situation spinning out of control. That story is where we begin this hour. The White House looking to limit the fallout from an Israeli strike on Iranian gas fields. Retaliatory strikes causing extensive damage to a Qatari complex housing the world's largest LNG export plant. The president playing down U.S. involvement, suggesting no more such strikes will be made unless Iran continues to target similar assets in Qatar. It's a struggle to turn down the temperature.
Yeah, right now we're talking not just about oil barrels and gas shipments that aren't traveling in the strait, but we're also talking about barrels that are not going to come back so quickly because of energy fields that are getting struck. Halima Croft of RBC really nailed this. She said, "We think there may be too much emphasis on the taco trade, as Iran could continue attacks even if President Trump seeks to call time to restore a measure of deterrence against future American military action."
And they are continuing attacks. We saw a huge port on the Red Sea, a refinery at that port in Saudi Arabia that was hit today. Yesterday, it was all about Qatar. This is a new phase of the war. Military installations are not only the targets now, actual energy infrastructure, and I'm talking about massive energy infrastructure facilities are at play right now. And that is why you see Brent crude absolutely spiking in response to what is going on in the region.
Let's work through the price action piece by piece. Just unpack this briefly. Look at the US versus Europe in the equity market so far this morning. Equity futures stateside on the S&P 500 just about unchanged. Check out Europe. On the DAX this morning, down by more than 2%. And look at this. The spread that's opening up between WTI and Brent, close to $20 earlier on this morning. Brent up by 7, WTI unchanged. What do you think that is starting to speak to?
It's starting to speak to a divergence between two markets, both the European Brent market and the U.S. market, which implies that they can stay separated for a prolonged period of time. Sure, the physical barrels that are coming from Iran and from Iraq and from Saudi Arabia are going largely to Europe. You also see, of course, natural gas and a question around exactly where they're going to get it, given that a fifth of the supplies are now potentially offline for a while. At the same time, is there no coming together of these two markets? That really raises a question.
The United States is a net energy exporter. I think what the market is reading right now, that besides the Jones Act waiver, which yesterday the president signed, which is going to mean that any vessel, it doesn't need to be a U.S. vessel, can carry energy products to any port in the United States. The market, I think, is starting to price in the fact that the next step this administration can take is banning export of products. And that is why WTI is tamed and Brent is going to go potentially parabolic.
Brent crude this morning, 115 and higher by more than 7%. Coming up this hour, we'll catch up with Seema Shah of Principal Asset Management with stocks pulling back. Michael Hartnett of Bank of America as private credit concerns press on. And Krishna Guha of Evercore as Fed Chair Jay Powell vows to stay on through the DOJ investigation. We begin this hour with our top story. Crude surging past 110 following strikes on major energy sites across the Middle East. Bloomberg's Jumana Basechi joins us now for more from Dubai. Jumana, good morning. Escalation in the last 24 hours.
Indeed, John, and that's kind of been the theme every single day. Day 20 of this war, another major escalation overnight. And after those Israeli airstrikes on Iran's main gas field, the South Pars gas field, Iran did vow to retaliate in a meaningful capacity. They said that the energy infrastructure sites across the Gulf would be legitimate targets. And indeed, that is what transpired in the evening yesterday. They have essentially lashed out at multiple Gulf states and at some of these key areas, including refineries in Kuwait, refineries in Riyadh. We've just heard as well in the past hour that they also launched attacks at the Yanbu port. That is a key port on the Red Sea. So they're targeting a different part of a whole different geography now, and has been a key source for Saudi Arabia to reroute some of their own oil. But I guess the biggest development, the most notable one, has been them targeting that Ras Laffan facility once again in Qatar. Now, in the early days of the war, they did target this same facility, which led Qatar Energy to announce this force majeure. But the difference is yesterday, while Qatar authorities successfully intercepted 4 missiles, one of the missiles managed to penetrate, it broke through and caused, quote unquote, extensive damage. And that is the language that was put out by Qatar Energies themselves. And so we've moved on to a new phase here where the market doesn't just have to account for the disruption of flows and the fact that the flows are being stuck in and around the Persian Gulf, but possible destruction of physical supply as well. And this is the key game-changing moment overnight. President Trump is trying to distance himself from those initial Israeli airstrikes on the Iranian gas fields. But I will say the response that's coming through from the Gulf states really speaks to one of anger and the fact that this, from their perspective, is a massive game changer. The perception is that Iran have really crossed the red line here. You don't have to go so far. The ADNOC CEO, Sultan Al-Jaber, just put up a comment on LinkedIn saying that this weaponization of energy needs to stop. Civilian infrastructure should not be a target. The Saudi foreign minister has gone one step further and said that their patience is not indefinite, and Saudi Arabia reserves the right to respond in a political fashion or, and he adds, in a non-political fashion as well. Qatar Ministry of Foreign Affairs put out several statements overnight calling this a flagrant violation of their sovereignty. They also kicked out the military and the security and political attachés that Iran had in the country. So a major escalation.
Jumana with the latest. Jumana, thank you. Jumana Betsy out of Dubai, leading our coverage out of the region again this morning. This is odd. The president attempting to distance himself from events in the last 24 hours. Axios standing by their reporting. We've touched on that a few times. The strike was carried out in coordination with and with the approval of the United States.
Yeah, and the same reporter who broke the news initially came back and said when he spoke to a number of officials, both in the U.S. as well as in Israel, they confirmed that the U.S. was aware of this. It is a real question. What is the signal that President Trump is trying to distance himself and distance the United States from these strikes? Is that an attempt to de-escalate things? Is this an attempt for domestic popularity? Is this an attempt to potentially placate some of the Saudi Arabian and UAE leaders? A real question about the signal more than the actual fact here.
Our reporting as well. The U.S. was aware of what was going on in terms of Israel going after South Pars, didn't participate, but was aware. Jumana touched on a really important point right now. The capitals in the Gulf are turning their back on Tehran in a very dramatic way. They are very annoyed and they think they have crossed a red line. On top of that, though, the Wall Street Journal says Arab governments are also furious about Israel's attack and the U.S.'s failure to head it off.
Let's get to the view on Wall Street this morning. Seema Shah of Principal Asset Management writing our base case remains that the disruption to oil markets is ultimately transient. The pullback in global equities, though, particularly in the U.S., has not yet been sufficient to warrant adding risk. Seema joins us now for more. Seema, welcome to the show. Let's pick up on a market move that we touched on at the start of this hour. The gap that's opening up between Brent and WTI. That spread is very wide this morning. What do you think it speaks to?
Hi, John. Well, as you said, it's really a focus on the fact that Europe is so much more exposed to this conflict. The economic impact for Europe could be considerably greater than what we could expect for the US. And I think a lot of this is in relation to certainly to what you're talking about with this spread opening up. From a portfolio perspective, this is really key because, as you know, international markets have outperformed the US, had outperformed at the beginning of the year. And you've seen a lot of flows into international markets, moving that kind of asset allocation to an overweight international exposure. And this is a really uncomfortable time, I think, for investors.
You mentioned dislocations and potential opportunities. Has a gap opened up, not in the US, but in international equities, that gives you the opportunity to step in?
Well, so look, there has been a gap opened up, and in some ways you could look at it as an opportunity. But unfortunately, as we're seeing with exposures across all markets, it's just too early to be making any key portfolio decisions when there is so much uncertainty on board. I would say that the escalation overnight has clearly increased the downside risks. The base case scenarios of this being quite a short-lived attack, conflict where you see oil prices then returning back to their pre-crisis levels, that is receding quite quickly. So I think at some point there will need to be reallocations. At the moment, though, investors are almost paralyzed, waiting to see how the conflict ends. And, we saw this certainly from Jerome Powell yesterday, and I expect that to come through from the other central banks, their decisions this week.
Seema, it does seem like to the degree that people are paralyzed, they are making some moves, and it's back into U.S. assets. And in part, it speaks to this divide between Brent and WTI. It seems like the United States, for now, is more insulated to the price shock that is really rippling through emerging markets and through Europe. Do you think that once again, there is a haven quality to U.S. assets that you also are disproportionately allocating to?
Yeah, absolutely. I mean, one of the things that we've seen is the US has reasserted itself, has reminded everyone else again that when there are headwinds and when there are shocks, the US tends to be the outperformer because it's considered to be more resilient. Now, of course, in this situation, this is very specific, given that the US is an oil and energy exporter. But I think that for investors, you're reminded this is a safe haven. And of course, with that comes a technology trade. Tech, which had been beaten up a few weeks ago, has been a reminder to investors that, look, when you're going through tough times, particularly from a macro perspective, tech is a relatively macro agnostic asset class. And it's one of the few asset classes which shows a lot of very strong balance sheet, strong cash flow. And essentially, that's where investors want to be focusing on in moments of difficulty and turbulence like we're seeing right now.
Seema, are you getting more concerned about risk assets more broadly? Because, as you said, the central banks globally are having trouble responding to what ultimately could be a stagflationary shock. Currently, we're looking at a Fed funds rate that's not pricing in a rate cut until October 2027.
Right. And we've seen historically that equity markets, for example, typically perform worse in a geopolitical crisis when the Fed, other central banks, hike in response to the increase in inflation. So certainly that is what markets are really looking out for, which is the way the Fed, the ECB, the Bank of England, et cetera, are going to be moving. But, at this stage, just like investors aren't really sure about how to respond to this, it certainly seems like that's the same from the central banks as well, waiting to see how this pans out. How do the economic forecasts adjust? There is just so much uncertainty with this specific conflict that it is making the positioning decisions very tough.
Seema, do they not know how to respond, or have they been conditioned differently? Elisa brought up this note from RBC's Halima Croft, who says, we think there may be too much emphasis on the taco trade because Iran could continue these tactics. Do you think that the market is starting to wake up that Donald Trump himself cannot control this outcome?
Yeah, I think that is such an important point. As you said, the first 2 weeks of the conflict, their view was that, we've seen from many times in the past that geopolitical conflicts tend to be very short-lived. That was one. But the second point being that the Trump administration would essentially call victory early days because of concerns about affordability and in a midterm election year. Now, in the last week or so, we have seen that dynamic shifting, where there is greater understanding that this may not be the US's ability to call victory and leave. This is very much this is becoming an area where Iran can call the shots. And that is one of the reasons why the expectations for oil prices to jump right back down again is fading. And so we would certainly assume at this point in time that oil prices, energy prices worldwide will stay fairly elevated through the rest of the year, even if the conflict comes to an end in the next few days, which at this point in time seems very unlikely.
Hey, Seema, good to see you. Thanks for being here. Seema Shah there of Principal Asset Management. So what have we learned in the last 24 hours? There is no central bank circuit breaker coming anytime soon. And as we've witnessed over the past few days, this isn't totally in the president's hands. Someone else has control as well.
Typically, the playbook is when you get a disruption, especially geopolitical, you wait until things get bad enough, and then there's a policy response. And what you just pointed out is that there isn't exactly a policy response that's as obvious as there has been in the past. The Fed is not necessarily in play here. And frankly, President Trump may not hold all the cards to unilaterally turn this off.
Oil surging this morning, Brent crude specifically, equities just about unchanged stateside, rolling over in Europe. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Yahya has more. Hey, Yahya.
Good morning, John. President Trump hoping to pare back attacks on Middle East energy assets after Iranian and Israeli strikes on major gas fields. The president saying any additional attacks by Iran on Qatar's LNG facilities would prompt the U.S. to, quote, massively blow up the entirety of the South Pars gas field. Fed Chair Jay Powell isn't going anywhere. Powell saying he has no plans to leave his post until the DOJ finishes its investigation into him and the central bank. Powell adding that he has not yet made a decision about whether he will serve his full term as governor, which runs until 2028. And we are seeing Micron shares falling nearly 5% in the pre-market. The company warning it will need to spend heavily on production to meet demand. It expects capital spending to be above $25 billion this fiscal year. The spending reflecting the cost of keeping up with demand for Micron's memory chips, especially those components used in AI computing. That's your Bloomberg Brief. John?
Yahya, thank you. Thanks for the update. More from Yahya later this hour. Up next on the program, pressing on in Iran.
We've defined the objectives of Operation Epic Fury very clearly, which is, of course, to wipe out Iran's ballistic missile arsenal. The United States military has a lot of capabilities. They still do have tricks up their sleeve.
Up next, we'll get the latest from Washington, D.C. We'll catch up with Bloomberg's Tyler Kendall, live from New York City this morning. Good morning. If you saw this morning, you'd have no idea what's been happening in the commodity market overnight. Equity futures just about unchanged on the S&P, down 0.1%, on the Nasdaq down by 0.2. Check out the moves in crude. Brent overnight a high of 119.13 and right now around 115. We've talked lots about that spread opening up between Brent and WTI. It is wide and got very close to $20 earlier this morning.
These two markets are diverging at the fastest pace and the most, barring the pandemic in a couple days there, going back to 2013, at least at one point. And the argument here is that European markets are much more affected by the barrels coming out of the Middle East. Is there something more? As Annmarie was mentioning, is it going to be export controls? Is there going to be some sort of restriction? Oil companies going down to D.C. to talk with the president. Let's hear what comes out of that.
Some breaking news from AMH in the last 24 hours. We'll get the details of that in just a moment. Under surveillance this morning, pressing on in Iran.
We've defined the objectives of Operation Epic Fury very clearly, which is, of course, to wipe out Iran's ballistic missile arsenal, and, of course, to ensure that, yes, Iran cannot permanently cannot possess a nuclear weapon. The president is going to continue to talk to our allies. The United States military has a lot of capabilities. They still do have tricks up their sleeve.
So here's the latest this morning. The White House looking to cool tensions after attacks on oil and gas facilities, sending energy prices soaring. President Trump saying the U.S. knew nothing about an Israeli attack on an Iranian gas field. Bloomberg's Tyler Kendall has more from the White House. Good morning, Tyler.
John, good morning. Well, the message from the White House is clear. They are seeking de-escalation after we saw this surge in attacks on energy infrastructure overnight. And while President Trump sought to distance the U.S. from Israel's attack on Iran's largest natural gas field, a person familiar with the matter does tell Bloomberg News that the U.S. was aware of the operation, though did not participate. President Trump now vowing that Israel will not hit any energy infrastructure targets in Iran going forward unless Iran continues to hit the energy infrastructure targets of its neighbors. Of course, after we saw Iran release this list of potential targets yesterday, we saw the country hit multiple projects in Saudi Arabia, the UAE, Kuwait, and Qatar, as you know and have been covering. That included, quote, extensive damage on the world's largest LNG export facility. But this White House has suggested that it is now reluctant to hit that infrastructure that could impact global energy supplies. Even after President Trump reiterated a threat earlier this week, we could see attacks on energy infrastructure on Karg Island, where nearly 9 out of every 10 barrels of Iranian crude flow through. And data and imagery shows, for the most part, those loadings have continued unabated. But all of this escalation is really complicating the White House's efforts to help curb what has been that surge in energy costs and bring them down for U.S. consumers. Just yesterday, of course, the White House moving to issue that 60-day waiver for the Jones Act, essentially trying to make it cheaper to move energy products between U.S. ports. John, as Annmarie was reporting, we are expecting those oil executives here at the White House today. I'll put one other meeting on your radar as we see this administration try to find some potential solutions. President Trump next week is expected to meet with biofuel makers amid a push from some farm state Republicans to get a waiver for higher content ethanol gasoline to hit the market.
Tyler Kendall with the latest from outside the White House. Tyler, thank you. More from Tyler in the next hour. This headline just crossed in moments ago. A media report suggesting the Iranian response to the damage to the South Pars gas field is not complete. The attack is not complete. That's an important line coming out of Iran this morning following the president's statement a number of hours ago.
It means they're going to continue, and you have to ask yourself a question. Does this mean the president is now boxed in? Because he said energy infrastructure needs to be off limits, and we will respond with a bigger force if it's not. Well, Iran right now and the IRGC is saying it's not. We're going to continue.
I want to understand where exactly Saudi Arabia, Qatar really fall in here, because they said that, as you pointed out, this is a red line that's crossed. They're not happy with Israel. I'm sure they're not that happy with the United States. At what point do they get involved as well, given the fact that their infrastructure potentially is at risk?
Let's get into the conversation with Yahya of the Carnegie Endowment for International Peace. Welcome to the program. Have we opened up a new front in this war?
Good morning, and thank you for having me. It's not a new front, but we've moved from the kind of political, military and security front to expand on the energy front. What I mean by this is much of the targeting by Israel and the United States was focused primarily on political and military and security targets. Iran decided to weaponize the global economy, closing the Straits of Hormuz. So it upped the ante. And this is its response to the attack on its own gas fields. I mean, we're on an escalatory path. And what Iran is saying, I'm fighting for existence. I will do what it takes. And if I'm going to go down, you're all going down with me. I mean, that's the bottom line.
From Iran now, it's not just that the energy cannot pass, it's that we will not allow you to produce any more of this energy. So what is the off-ramp from here? Because it's clear from the United States, even though we have reporting that the U.S. knew about this Israeli attack going towards South Pars, the President of the United States is clearly trying to take the tone down a notch. He wants energy facilities taken off the target list. Is that even possible at this point?
I think it is possible, but Iran is going to try and extract a high price for that, or a price for that. For Iran, or this Iranian regime, let's just distinguish, for this regime itself, it really is a fight for survival. They see this as an existential conflict. And what they want is, at the end of the day, whatever ceasefire, whatever arrangements are put in place, A, they will not be targeted again. So it's not a lull between two wars. And B, economic sanctions relief. We all know how much trouble they're in on the economic front. They have no fiscal space really to address the needs of their own population. And they want to maintain some sort of regional leverage. I mean, these are basically their demands. And unfortunately, by getting into this war, by launching this war, what Israel and the US has done is given Iran the space to use its leverage. It's discovered that perhaps, having control over the Hormuz Straits is more powerful than having a nuclear weapon in some ways. It has a much bigger global impact.
Given the fact that we have seen broadly some serious figures within the regime killed by the Israeli strikes, if the United States was to have a diplomatic conversation with Iran, who would it be?
That's the big question. I mean, the killing of Ali Larijani in particular basically ended the potential of speaking with someone who has a long history. The man was brutal. He was everything you want to say he was. But at the end of the day, he was one of their longest serving diplomats, and he was someone quite well known, a known quantity, if you like. Now they'll be dealing with perhaps somewhat less experienced individuals, and perhaps more hardline individuals. Kalibov comes to my mind. He's the head of the Iranian parliament, and he's a pretty powerful figure, but quite hardline, if you like. Saeed Jalili, who's going to be taking over, as we understand from the Iranian side, he's going to take over Ali Larijani's spot. So it's a big question. Let me put it this way. And it's just made things a lot more difficult.
We have to leave it there. It's good to see you. Thanks for making time for us. A tense moment in your region. Yahya there of the Carnegie Endowment for International Peace. From New York City, you're watching Bloomberg TV. Escalation in the Middle East, close to 120 on Brent overnight. Right now, about 114. Crude higher, Brent crude higher, up by close to 6%. WTI down by 0.3, a big gap opening up close to $20 earlier on this morning. That's the story in crude. And look at the gap opening up in equities. The US versus Europe. Equity futures on the S&P down by about 0.1%. Check out Europe. Look at the European stock story so far building today. Down on the DAX by 2.3%, on the Euro Stoxx 50 by 2 percentage points. The international story being upended by a major rally in Brent crude and in gas prices too.
Yeah, gas prices in particular, given the fact that the Qatar field is now offline and potentially suffering from extensive damage. This accounts for about a fifth of supplies and is one of the main suppliers to the Euro region since Russia has been excluded from their repertoire. Our question here, how do they manage this? How do they afford to pay for some of the expensive bills that people are going to be experiencing this winter? And how does the ECB respond? We're going to hear from them later this morning.
Good luck to the ECB. If the news conference with Chairman Powell was somewhat hawkish, what choice has President Lagarde got? Chairman Powell choosing to anchor inflation expectations in that press conference yesterday, helping to send yields higher at the front end by close to 10 basis points and up another 3 so far this morning. 380, breaking through levels we haven't seen since last summer.
And they have the luxury of saying that a rate hike is not in their base case and that nobody is really considering that as a serious proposition in the near term. Does the ECB have that luxury? Right now, you've got a market that's pricing in 2 rate hikes from the European Central Bank. Can they come out and say a rate hike is not on the table?
3 hours away from the opening bell. Let's get you some single names, some morning movers. Yahya has more. Hey, Yahya.
Hi, John. It's a story we've heard time and time again this earnings season. Companies getting punished for spending big, and Micron is the latest example. Yes, demand is booming for its memory chips, with the revenue guidance coming in well above analyst expectations. But it's coming at a cost. The company saying it will spend more than $25 billion in CapEx this fiscal year, and that is sending shares lower. 5.6%. We turn to gold stocks, all lower today as we continue to see a slide in gold prices for a 7th straight day. And the story here is inflation, with, of course, oil prices surging. Then you have the hotter than expected PPI print we got yesterday. And, of course, Fed Chair Jay Powell saying no rate cuts until inflation comes down. So all that weighing on the price of gold and weighing on names like Newmont down 7.25%. And we end on a positive note with Five Below. Shares are up 6.3%. The company delivering a beat and a raise, saying that it's seeing strong spending across all income levels, with shoppers, especially young ones, still spending on its discretionary items. But as a value retailer, it could also be a story of consumers trading down, or, in my opinion, children just having too much discretionary income. John?
Spending someone else's tax refunds. That's what's happening, Yahya. Thank you. The latest there on some of the retail stories. On our radar this morning, European natural gas prices surging following an attack on the world's largest export plant in Qatar. The site hit by an Iranian missile causing extensive damage. President Trump saying the US would retaliate if the facilities are struck once again. Elsewhere, Fed Chair Jay Powell saying he has no plans to leave the central bank until the DOJ finishes its investigation into him and the central bank. Powell adding he hasn't decided if he'll serve out his full term as a Fed governor. And finally, HSBC considering major cuts to its workforce due to the rise of AI. The cuts would focus on non-client-facing roles and could impact as many as 20,000 jobs, or about 10% of its staff.
Yeah, and this is a plan that they're going to develop in the next 3 to 5 years. It's not definite yet, but it comes amid already a real shakeup at HSBC. 2 points. Number one, how much are banks and other companies going to be using artificial intelligence as a way to curtail some of their staff in general? Because some of these cuts might come in the form of selling some units. So this isn't exactly a wholesale discarding of them for the sake of AI. On the other hand, right now, Bloomberg Intelligence is expecting about 200,000 positions in the banking industry to get withdrawn from the industry as a result of AI. So definitely feeding into the fear that's out there.
That's a story to keep on tracking. We're tracking this as well. Bank of America's Capital Markets Conference underway in Paris. Joining us now is Bloomberg's Francine Lacqua with a special guest. Good morning, Fran.
Good morning, John. I'm so happy to speak to Michael Hartnett of Bank of America. Michael, thank you for joining us. Look, you've said the markets are starting to resemble the run-up to 08. What do you mean, and what are you looking at?
Well, one big difference, of course, with 08 is that the oil shock there was demand-led. You know, it wasn't supply-led. It was China, India. So, yeah, you definitely have an environment where oil prices are rising to, you know, high levels. You know, back then, you know, the similarity perhaps is that you had these, you know, credit tremors sort of bubbling away in the background. So that's the similarity, and certainly the price action year today is fairly similar. But, you know, the supply shocks are more sort of 73, 79, 2022. And I think that the market generally has been coming into this thinking it's supply shock, it's short term, and therefore it's going to be over pretty quickly. And I think that's the kind of revision that the market's going through in the last couple of days.
Is that complacency, or are they too complacent? At what point does it start feeding through earnings?
Well, I mean, it will feed into earnings without a question. But I think that coming into this, you know, people are long equities, that they're hedged, but they are long. But I wouldn't say it's complacency, but everyone thought it was a short war, yeah? Everyone thought it would be folded earlier and, you know, there's an election for Trump to win. You know, the market's too big to fail. You know, we've seen this script before. We don't want to sell. We're always... So I think what's happened the last couple of days is kind of like people have said, I don't want to sell because the policy will change, right? And it's now, actually, we're going to have to sell to change the policy. Do you see what I mean? So it's kind of like it's flip-flopped a little bit.
But Michael, I mean, I thought was striking is that the market was pricing in some kind of short sort of resolution in the shorter term. But actually, if you read the geopolitics and if you read all the transcripts, that just wasn't there. So is the market looking for something?
Yes, I mean, look, the market's looking for an off-ramp. The market's looking for a ceasefire. The market's looking for an end. The market's desperate for the oil price to not move in an exponential way to the upside, but actually, you know, back down because... You know, the other thing that's been happening before this is that you've been having this tightening of financial conditions, yeah? And so the market needs an easing of financial conditions, but the Fed finds it tough to deliver that if oil's at, you know, 150, 200, you know, but I think ultimately you will get that easing of financial conditions, but this obviously delays it somewhat.
What do you think is most being mispriced right now?
Well, I think that if you look at the, you know, the broader markets, I would say that equities still look rich, you know, relative to where they could do in a genuine shock where the Fed is, you know, not able to cut interest rates. I think that we've gone on record saying 6,600, you probably want to start nibbling at the S&P. I'd be buying the 30-year Treasury above 5%. I'd probably be fading the DXY dollar index above 100. But as I said earlier, the risk right now is that kind of those numbers need to get worse before they get better. Because you look at the Bank of America Fund Managers Survey last week, people are not sure. You know, they're still bullish, certainly on equities.
So do you think oil does go to 150 and possibly 200? Those are the levels you mentioned.
No, they'll go. No, I mean those are levels predicated basically on this is ended in weeks, not months. If it's protracted or you get an additional sort of 20, 30, 40%, no, those levels are breaking. You're going to have to wait for much lower levels to engage, certainly in stocks.
I mean, what's the risk of a policy mistake by central banks? I know you've also said there was a hike in 2008 by the ECB that you said was the worst possible policy mistake.
Yeah, look, I always have this sort of catchphrase, sort of markets stop panicking when policymakers and central bankers start panicking. I don't think the Fed... I don't think the idea the Fed is going to hike, I think, is nonsense. I don't think that's going to happen.
Will they cut?
I don't think they're going to. I think they will eventually cut. And again, I think that, you know, people say with a high oil price they can't cut. 6 months ago they cut with the stock market at an all-time high and corporate bonds at an all-time high. So, but this is the history that we've all got in us, the DNA. We're all... the QE we're all Gen QE. Do you know what I mean? In that we're all used to central banks wading in whenever there's a market, you know, problem, and hey ho, off we go again. So I think again, maybe you have to sort of like break that expectation a little bit first. But I think no doubt the puck now in the markets is moving like we need an easing of financial conditions, whether it's oil, whether it's yields, whether it's Fed, whether it's the dollar, and we're going to go down until the policymakers hear that and deliver that.
So where do you put your money right now?
Well, I think broader terms, as I said, I think the consumer, ironically, is what I would be nibbling at this particular moment. No one loves the consumer. Oil's up, unemployment's rising, but to me, the consumer stocks are the ones that have really discounted stagflation. Yeah. And if you think post-Iran, what has Trump got to do? He's got to win the midterms. And you're not going to win the midterms by, you've got to win the midterms by addressing affordability really. He has to pivot to that just, in a really dramatic way. And again, I think that affordability, lower income consumer that everyone dislikes at that moment, that's probably where from a trading perspective, I think the best, trading opportunity is. Longer term, however, I still think international commodities, these are the true sort of secular bull markets of an inflationary 2020s.
Michael, thank you so much. Michael Hartnett there from Bank of America. I'm going to send it back to you, John, in New York, and we'll have plenty more throughout the day here from Paris.
Looking forward to it. Thank you very much, Fran. Appreciate it. Thank you very much. My favourite phrase of the morning so far, Gen QE. Conditioned, right? Conditioned from the QE we've seen over the last decade plus to keep buying this market because the Fed will step in if things go bad, and it feels very, very different in the last day or so.
Yeah, we're all Generation QE. When things get bad, hey, Papa Fed, let's get some help here. And Papa Fed saying, this isn't our bag. And guess what? Papa Trump saying, I don't know if I can, or that's what people are implying. And so suddenly the market is trying to digest what that means.
How much help is Mama ECB going to be a little bit later this morning?
Well, probably not so much. And then you have the Generation QE over in Europe that's going to be fretting.
Got our own problems over there. Let's get you an update on stories elsewhere this morning. With your Bloomberg brief, Yahya has more. Hey, Yahya.
Hi, John. French President Emmanuel Macron calling for strikes against energy and water infrastructure in the Middle East to stop. In a post on X, Macron writing, civilian populations and their essential needs, as well as the security of energy supplies, must be protected from military escalation. Meanwhile, India is sending additional warships to the Middle East to ensure the safe passage of its vessels. India anticipating that Iran may allow more of its fuel tankers to exit the Strait of Hormuz. Sources telling us here at Bloomberg the Indian Navy is deploying over half a dozen warships as a precautionary measure. And we are seeing yen strengthening after the Bank of Japan announced it was holding rates steady due to uncertainty surrounding the war in the Middle East. The BOJ decision matching the expectations of all economists surveyed by Bloomberg. The central bank voted 8-1 to hold, while pledging to raise rates if its price forecast materializes. That's your Bloomberg brief. John.
Yahya, thank you. Thanks for joining us. Up next on the program, the Fed chair digging in.
I have no intention of leaving the board until the investigation is well and truly over, with transparency and finality. On the question of whether I will then continue to serve as a governor after my term ends and after the investigation is over, I have not made that decision yet.
We'll get the view of Krishna Guha of Evercore next on the program, live from New York City this morning. Good morning to you all. This is Bloomberg. Live from New York City this morning. Good morning. Your day ahead looks like this. Two central bank decisions left in focus. One in the next hour. The next few hours, we'll hear from the Bank of England. Then later on this morning, 9:15 Eastern Time, you'll hear from the ECB. If you're waking up stateside, that time is slightly different to what we're used to. The time gap between Europe isn't what it was. That will flip back in the next week or so. So 9:15 for the ECB. Equity futures on the S&P 500 shaping up as follows. Futures this morning, negative just 0.1% on the Nasdaq, down by 0.3. Much greater losses over in Europe. Off the back of this, Brent crude significantly higher than WTI. Brent at 114, WTI at 96.90. Brent up by close to 6%.
This is an impact that's going to really affect the European region that much more than the United States, and that's playing out in both equity markets as well as in the Brent versus WTI gap. I just wonder what the ECB can say at this point, because ultimately the Fed told us we're out of the game. So can they really do anything about this when it's not necessarily theirs to print molecules?
I think you both said this yesterday on the Fed show, and great job on the special. The fact that there was a lot of humility from Jay Powell yesterday. We just do not know where this story goes, and they need to wait and see. So much that he said maybe we should just scrap the SEP because it is really hard to forecast in this environment.
I think there was also a lot of snark in central bank speak. I think there was some real pushback to the president and this White House yesterday. This is not my circus, and I'm not stepping in. And he pushed back across the board several times.
Yeah, until this investigation is well and truly over, I'll stay here. And until you have another Fed chair, well, the pro forma policy is that I shall stay on as Fed chair. And guess what? We're just trying to dodge the balls as they come in and do our best.
Let's get to the bond market. 2s, 10s, 30s at the front end of the yield curve, up by close to 10 basis points in yesterday's session. Add a number 3, 380. 380 at the front end of the yield curve. That's the highest yield we've seen going back to July of last year. Think about all the rate cuts we've had. 380. This is a market pricing out easing. So now basically the 2 years in line with the upper end of Fed funds, that range. To believe that yield goes higher from here, you've got to think there's a risk of hiking interest rates at the Federal Reserve. That's a much higher bar now, I think, for this Fed and ultimately for this market.
Jay Powell said that yesterday. He said ultimately that's not in our table. That's not in our bag of tricks right now that we're going to consider. That could change, right? I mean, ultimately, if this is a data-dependent and subject-dependent type of Federal Reserve, well, you have to imagine that they're going to have to consider everything, especially if the rest of the world is doing the same. My question is, how much does the ECB and the Bank of England drive the bus, and how much does the U.S. have to respond? Ultimately, there's so much unknown, it's very hard to game out.
Under surveillance this morning, the Fed chair staying put.
If my successor is not confirmed by the end of my term as chair, I would serve as chair pro tem until he is confirmed. I have no intention of leaving the board until the investigation is well and truly over, with transparency and finality. On the question of whether I will then continue to serve as a governor after my term ends and after the investigation is over, I have not made that decision yet.
So here's the latest this morning. The Fed Chair Jay Powell vowing to stay on at the central bank until the DOJ investigation into him comes to an end. Joining us now to discuss is Krishna Guha of Evercore. Now, Krishna, welcome, first of all. We've asked this question a number of times in the last 24 hours. I'd love your perspective on it. Does that provide consistency or invite controversy?
I think Powell has made explicit something that I think was very clear to anyone who knew him. There is simply no way that he would even consider leaving the Fed under the cloud of this investigation, not really because of what it means for him, but because of the precedent that it would create, that a future Fed official, even Fed chair, could be, on the face of it, driven out or at least helped to the door by a DOJ investigation.
This line here, though, I think is interesting, Krishna. The first line from the chairman was that if my successor is not confirmed by the end of my term as chair, I'll stay on. That makes sense. That's continuity. Market wants to see that. The second line was I have no intention of leaving the board until the investigation is well and truly over, with transparency and finality. So ultimately, a lot of people will view that as defending central bank independence. Granted. The third point's interesting, though, and this is the bit where I'm intrigued, Krishna. This line at the moment. On the question of whether I will continue to serve as a governor after my term ends and after the investigation is over, I have not made the decision on that yet. What's the value of putting that out there?
Well, I think you're absolutely right that that was a very strong statement by Powell. And as you'll recall, it wasn't something he was forced to say because of questioning. It's something he volunteered. He had it written down. He knew he wanted to say that. Look, there's a sort of narrow sense in which we can interpret that in a wider sense. The narrow sense is that Powell doesn't want to look like he's offering a deal. If you drop the investigation, I walk, right? That's almost as bad as looking like you're being hounded out by the investigation itself. So there's a narrow way in which we might interpret that language. But I'm inclined to read it also in a broader way. That Powell is telling us that he is seriously considering staying on as a governor, as a regular governor, at least for some time after the end of his term as chair, even if that investigation is dropped. That is not something I would have really bought into a few months ago, but I think the DOJ investigation has backfired terribly on the administration, and I think that it feels like Powell is inclined to stay possibly either way at this juncture.
I'm struck by the historical parallel, and we were talking about this yesterday. The last person who was Fed chair who then stayed on as governor was Mariner Eccles. His term ended as Fed chair in 1948, and he stayed on for a number of years after that. This was following the Bretton Woods Accord. It followed the war. It followed a highly tumultuous period in central banking history. Are we marking another period which is sort of setting off a new era for central banks where they have less power, where, frankly, they don't necessarily drive the bus, where Generation QE, as Michael Hartnett just said, is over?
Well, certainly, the note we published on the Fed meeting yesterday said specifically what you've just mentioned, that, look, this was actually, in the circumstances, a pretty dovish Fed meeting, and it came with bullish upgrades to growth forecast. But we wrote the Fed is not driving the bus. Now, that's in the specific context of a war, and a war that generates a very large shock to energy prices. I'd be wary of making a generalized statement that central banks don't matter anymore. I think that would be, I'm not saying you're saying that, but I think that would be far too sweeping. But certainly in the here and now, this is a context where the central banks are to a very large degree in reactive mode. They are not setting the agenda. They are not shaping where we are going. Does it feel to Powell potentially like this is a complex moment, both in terms of the world and in terms of the Fed's institutional situation, where it may be advisable for him to stay for a while? I guess that's certainly something that, he will be considering here. One question, I think, is whether it would be a disaster for Chair Walsh if Powell stayed on. Not clear to me that's the case. I'm not sure they're particularly close, to say the least. But Powell is underlying pretty dovish. And there are versions of the world where Powell staying on as a regular governor could ultimately help bridge to getting one or two cuts done later this year under Walsh.
Just real quick here, how high is the bar right now for the Fed to hike rates at some point?
Well, the term "some point" obviously is elastic, right? But I think the bar to the Fed hiking rates, let's say this year, I think is incredibly high. It's not literally impossibly high, but I think it's very, very high. Look, we have an economy that faces growth as well as inflation risks, but one where, in the baseline case, both growth and core inflation in the U.S. ought to be relatively resilient, as in limited effect, compared with the other economies in the rest of the world. So it's not obvious at this juncture a major shift in the direction of policy is appropriate. The market obviously has been pushing back and shaving Fed rate cuts. That seems like the vector that is in play at the moment. I tell you, we still think that it's possible to get to a couple of cuts this year under Chair Walsh. So our take is more dovish than the market right now. We think the old Fed signaled yesterday they're still inclined to cut the one rather than two. And the question is, could the data plus the new chair potentially certainly lock in that one and maybe get them to two?
Krishna, good to see you. Thanks for jumping on for us. Krishna Guha there of Evercore. If the chairman stays on after another chair has been confirmed and the DOJ investigation goes away, I'm sorry, that is incredibly controversial.
I'm sure it will be discussed. I'm sure we'll get a Truth Social post on it potentially, which is actually interesting. He's been pretty quiet.
Forget the president. This is Chairman Powell. It'd be controversial for him to decide to do that.
Especially given the timing, and that's a key question.
Coming up, Dan Skelly of Morgan Stanley, Edward Fishman of Columbia University, Samantha Dart of Goldman Sachs, the former Fed governor, Betsy Duke, the second hour of Bloomberg Surveillance, up next.
We don't know the off-ramp. We don't know the end point.
I'm increasingly nervous the market's not pricing this in.
The market's not giving us much of a buying opportunity, quite honestly.
I don't think we've priced in peak fear yet.
If it goes on for a long period of time, we would probably expect a significantly lower move in risk assets.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your scores look like this. Some calm in equity futures following yesterday's declines. We're down by 0.1% on the S&P. On the Nasdaq, down by 0.3%. In the commodity market, some big moves on Brent, versus WTI. Brent crude at 114, close to 120 overnight, much higher than WTI at 97. A big gap opening up between the two. That's pushing European equities so much lower in today's session relative to what we're seeing stateside.
The energy shock in Europe is far exceeding anything that the U.S. is potentially poised for. That said, this gap is raising questions about how long you can get a divergence like this. I mean, this is the widest divergence outside of the pandemic going back to 2014. And you're looking at this and you're saying, OK, does that mean the U.S. is really going to divorce its market from the rest of the world? I also wonder what kind of policy response you can get. What can you do to bring prices down other than end the conflict in Iran and get production back going?
Well, I think the spread just shows that the U.S. does have more flexibility. One, we are a net exporter, and the president, they are discussing potentially banning exports of products. Now, what does that mean for price on the global market? Actually, potentially prices will go up. But that is a lever that this administration is discussing, and potentially they're going to discuss it today. Oil executives will be in Washington, D.C., and they're meeting with Vice President J.D. Vance.
More central bank decisions coming up later on this morning. The Bank of England, look out for that. The ECB following that one. There is no central bank circuit breaker to this crisis in the Middle East. That's the takeaway in the last 24 hours. Jeff Curry of Carlyle on this program. What was the big headline from him? You can't print molecules. You cannot print barrels of crude.
And that's really what we heard from Fed Chair Jay Powell, just trying to, as we were saying yesterday, play dodgeball, because ultimately they don't have a lot of control here. Given that, where does the market's confidence come from? At one point it was taco, but as Halima Croft said, well, Trump doesn't hold all the keys to necessarily de-escalate, given the fact that Iran faces existential risk and wants to impose a real premium on any kind of conflict ever happening again like this.
And I think the last 24 hours shows that we are entering a new phase. It's not just military facilities that are now targets, it's energy facilities. And the IRGC is saying that yesterday's strike on its South Pars gas field, quote, is underway and not yet complete. Their response is not yet complete. And this comes after the President of the United States says if this continues, I believe the words were, we will massively blow up the entirety of that field. And given all the strength and power that Iran has never witnessed before. So Trump is sort of putting himself in a box right now. And the Iranians are saying we are not done yet. And you see that playing out as we speak across the Middle East.
There is a very real risk here. And you get that sense waking up early this morning that we're on the edge and very close to an escalatory spiral that no one has control of. That's what it felt like overnight, waking up to that post from the president following the attacks on energy infrastructure.
I keep thinking about what Jeff Curry was talking about, which is the people who are in the physical market are freaking out. And you see that reflected in the price, $40, $50 gap between that, the physical price, and the paper price. He's saying, well, the paper market's got to catch up. Other people saying, well, the physical market's just, affected by life. And ultimately, as this goes on for a longer period of time, the paper market has a greater chance of catching up to the physical.
Lots to catch up on this morning. Coming up this hour, Dan Skelly of Morgan Stanley as equities retreat. Samantha Dowd of Goldman Sachs as Iran's attacks on energy push crude higher. And the former Fed Governor Betsy as Chairman Powell vows to ride out the DOJ probe. We begin this hour with stocks losing ground as Brent crude surges. Dan Skelly of Morgan Stanley writing, despite the Iran conflict, we're still bullish on equities for the full year. Dan joins us now for more. Dan, good morning. Good to see you.
Good morning, John. Great to see you.
What is the anchor of that bullish view in a moment like this?
You got to recall that prior to the Iran conflict, which I don't want to diminish at all, we had a really solid exit rate with fourth quarter earnings, right? And we saw earnings growing double digit again, and we saw, importantly, a broadening out. Beyond that, we still have healthy corporate balance sheets and healthy consumer balance sheets for the most part. So that's the anchor.
Are they about to get beaten up by this move in crude?
They are to a certain extent, but let's recall we still think we're in this K-shaped economy and population effect where obviously the middle and lower income folks are going to deal with higher energy prices, but so much of the wealth and spending in the country is still dominated by the upper rung of the K that maybe that helps us get through.
At the same time, can you see momentum really continue if you start to see certain deals getting pulled from the market, certain M&A transactions getting delayed, postponed indefinitely, a sense that markets are getting a little bit nervous and they're not going to necessarily operate the way that they have for the first 2 months of 2026?
Good morning, Lisa. And no doubt, I think you are going to see uncertainty start to weigh on corporate confidence, on pipelines. Having said that, at Morgan Stanley, we clearly have a unique perspective on that particular topic, and we're still hearing at this moment enthusiasm for capital market cycles, M&A, IPOs, et cetera.
I love that, the idea that I come with the big cloud over my head. But isn't the world falling? I am just wondering, though, if you pair this with the idea that central banks aren't going to step in, that potentially you're not going to get a rate cut this year. The first rate cut now being priced in for October 2027 for the Federal Reserve. The ECB might signal that they're raising rates today, not necessarily today, but later this year. Doesn't that curtail some of the enthusiasm, this idea that we can live on free money forever?
Absolutely. So two things. First off, on the monetary side, we actually thought originally that if there was a risk to this year, because we already had a solid baseline coming into the year, it was a little bit of a be careful what you wish for if we run it too hot. Remember, run it hot? That was the risk a few months back. And look, sometimes you're right for the wrong reasons, and we got the inflationary shock from this exogenous event with Iran. But as we were just talking about with John, we do think the economy, given its unique drivers today, is more resilient than ever before.
Is there an opportunity in the bond market opening up at the moment?
It's funny you mentioned that. So our asset allocation committee is thinking very hard about that at the moment. And look, you're up above 4.25 on the long end today. We do think there is room to take a little bit of duration on here.
Okay. It's not particularly exciting, but I'm thinking more about the front end of the curve. I'm thinking more at twos right now at 381. The upper end of the Fed's target fund range is 375. So we're through that level. To believe we're going materially high here at the front end of the yield curve, you've got to believe they're going to hike interest rates. That feels like a really high bar to me this morning.
It's an excellent point, John. We don't see them hiking this year. So if you want to be even more conservative, you can kind of go to that belly of the curve too, even like the 5 to 7 part of the curve.
When do you think a hike could become a real conversation stateside?
As long as the Iran conflict is going on with this kind of whack-a-mole tweets and uncertainty day to day, I don't think you're going to see anyone thinking about hikes anytime soon.
But potentially, doesn't this become, as long as Iran continues, a hike becomes more likely because inflation could spiral?
Possibly, but also on the other hand, you have a potential for a growth scare as well. So I think that's a very fine needle to thread. Having said all that, let's step back. And like everyone else, I don't have a crystal ball on Iran, but I think the necessary analog to consider at the moment is Russia-Ukraine, where, to be fair, from a military perspective, you had probably much more evenness in terms of the military competition. And secondly, you got to think about the motives in the game. In terms of Putin's motives, which are unabated today still, obviously with the midterms hanging out there this fall, it's unlikely, we think, that this is going to persist for so much longer.
Yeah, but that's based on the case that Trump has a bigger say in this than the Iranians do. But that's not the case. This is almost equal. Trump even admitted it. It takes two to tango. Do you think the market is too conditioned by this idea of taco, the way Halima Croft outlined today in her note?
I think, frankly, when you look at taco over the last year or so, you can't blame the market for going to that conclusion, because we had tariff taco, we had China taco, we had iPhone taco, so we had a full buffet of taco over the last year or so. So you really can't blame the market. But having said that, I think the one nuance to your argument is that at the end of the day, Iran's eventually going to run out of military capabilities.
In the meantime, the other pillar of support that's been coming from the United States has been the tech story, and this idea that will save all. To some degree, some of the Fed's forecasts even are underpinned by the idea of more productivity coming from the artificial intelligence sector. How solid is that, given the fact that Micron delivered amazing earnings last night and is getting totally beaten up because they're investing more than people had expected?
Totally, and people are being reminded of the fact that that particular company is a more cyclical, hyper kind of beta type stock. What a surprise. We're reminded of that finally, after frankly running up 2-3x over the last several years, as you know. So, look, what we would say is we are still candidly benefiting from the post-COVID productivity wave. That was automation, yes, but really connectivity and communication, Zooming at all hours of the day. We haven't yet started to see the full benefit of AI productivity. But to be fair, when I talk to my colleagues in Morgan Stanley Research and we scrape the earnings transcripts, we are seeing quarter over quarter sequential specific use cases of AI in a lot of companies.
Does it encourage you when you see HSBC considering maybe cutting 10% of its staff as a result of artificial intelligence? Does that make you excited to buy shares of a company like that, the Blocks of the world? Or does that raise alarm bells that they'd be announcing it about what else is going on, that they feel the need to talk and sort of template some sort of layoff structure?
Yeah, so that is the $1 million question in terms of like the long run effects. I don't mean to be a double-handed economist, but I think in the short run, the market's going to pay attention to earnings revisions. And I think in the short run, it's going to be enough for investors, equity investors, to be excited. But in the long run, to your point, what are the socioeconomic and the bigger cultural implications of bigger job losses? We frankly don't know at this stage.
First thing I looked at when I saw the story, what's the stock doing? It's down 3%. It's not a block story. I thought that was interesting this morning, that HSBC is not rallying off the back of that.
Yeah, is this a question about how their reframing is going right now, given the fact that they've done a lot of restructuring already, that this potentially could be selling certain businesses? Does this signal that it's not going exactly as planned, or they've got more to do?
These are the kind of things we'd be talking about if we weren't talking about the Middle East. You've said this a few times. The other one, number one, private credit. I got a message from a Bloomberg subscriber moments ago, surprised that that didn't come up in the news conference with Chairman Powell just yesterday.
It's just amazing. It's frustrating for a lot of people because when you talk to investors, they're asked about private credit. They're not asked about Iran. Nobody's talking about Iran when you go to sort of investor meetings because it's not analyzable. There's nothing to say. But you can say a lot about private credit. You could analyze it and dig in. You can say a lot about AI. You can dig in. There's nothing to dig into here, which is the reason why so many people are saying, ignore it.
Were you surprised, Dan, yesterday?
It was surprising, and candidly, on our front, from the wealth management side, we are hearing a lot of private credit concerns for good reason. And look, at the end of the day, as our credit folks have said across the firm, we continue to see it more as idiosyncratic, less systemic. We would note that the lending between the interconnection between the financial sponsors and the banks, less than 2% of banks lending. So we do think, while messy and while you're going to go through this continued period of catharsis, it's not going to be a systemic issue.
Not downplaying what you just said, but I'd be shocked if someone from a bank said anything different. Dan, thank you, sir.
Fair point.
Dan Skelly of Morgan Stanley. I shouldn't have asked. Anyway, all right. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Yahya has more. Hey, Yahya.
Hi, John. President Trump calling for restraint on attacks targeting Middle East energy assets after Iranian and Israeli strikes on major gas fields. The president saying any additional attacks by Iran on Qatar's LNG facilities would prompt the U.S. to, quote, massively blow up the entirety of the South Pars gas field. Vice President J.D. Vance and other key administration officials preparing to meet with oil executives today. Sources telling us here at Bloomberg the meeting will focus on ways to lower surging fuel prices. According to AAA, the national average price for a gallon of gasoline has surged by nearly 80 cents per gallon since the war began. And Eli Lilly's experimental weight loss shot seeing major success in its latest trial. The GLP-1 helped diabetic patients lose over 15% of their body weight, more than any other drug currently on the market, yet shares are lower. Lilly sees it as an option for people with more severe obesity who may need a stronger treatment than the company's Zepbound shot or Novo Nordisk's Wegovy. That's your Bloomberg brief. John.
Yahya, thank you. Thanks for the update. Up next on the program, reining in energy attacks.
Nobody thought they were going to hit. They were, I wouldn't say friendly countries. They were like neutral. All these countries are getting hit. There was no expert that would say that was going to happen. If we did know, big deal. I mean, we have to do what we have to do.
Up next, Eddie Fishman of the Council on Foreign Relations, live from New York City this morning. Good morning. Dan Skelly of Morgan Stanley saying it just moments ago, we've had a buffet of tacos. Why would this be any different? Is this moment different? Equity futures right now in the S&P declining by 0.2%, on the Nasdaq down by 0.3%, on the Russell negative 0.6%, opening up a wide gap between WTI and Brent overnight. Brent crude getting close to 120 briefly, back down to about 114 and up by more than 6 percentage points. WTI up by just 1.4%. Natural gas prices having a major move as well. In the bond market, that unlocks higher yields, particularly at the front end of the yield curve. 380 now on twos, up 10 yesterday and up another 3. Yields the highest since last summer. That's notable.
We're pricing out rate cuts for the remainder of 2026 and most of 2027 as people look to the potential response function from a Federal Reserve that's hamstrung. And I think that that's the key takeaway. This is not a Fed that can counter this. They can be dovish all they want, but the inflation is staring them in the face at a time where the economy is chugging along, and that Delta and American are saying people are still spending. It is a difficult situation for the Federal Reserve.
This Federal Reserve constrained by escalation in the Middle East. Under surveillance this morning, reining in energy attacks.
Nobody thought they were going to hit. They were, I wouldn't say friendly countries. They were like neutral. They lived with them for years. I heard they were sending missiles to UAE. I said, that's strange. Qatar, their neighbors, they got along okay. All these countries are getting hit. There was no expert that would say that was going to happen. If we did know, big deal. I mean, we have to do what we have to do.
So here's the latest this morning. Energy prices soaring as President Trump looks to curb attacks on infrastructure in the Middle East, claiming the U.S. knew nothing of the Israeli strike on the critical South Pars gas field in Iran. Bloomberg's Tyler Kendall has the latest this morning. Good morning, Tyler.
Hey, John, good morning. Well, the White House is seeking de-escalation, though it doesn't appear that Iran is heeding that call as the country threatens we could see more attacks on Gulf energy infrastructure soon. Iranian state media reporting that a military spokesperson says that the country's response to Israel striking its largest natural gas field is not over yet. That's a pretty stark warning, considering that President Trump, in a post on Truth Social yesterday, vowed that if Iran continues to hit energy infrastructure of regional partners, then the U.S. will, quote, massively blow up what's remaining of the South Pars gas field. Still, the U.S. did try to distance itself from Israel's initial strike there, though a person familiar with the matter does tell Bloomberg News that the U.S. was aware of the operation but did not participate. This White House is now signaling that it is reluctant to hit oil infrastructure that could disrupt global flows. Even after earlier this week, President Trump reiterated a threat that energy infrastructure on Carg Island could be a target if disruptions in the Strait of Hormuz continue. And as you know, those disruptions are continuing, only complicating the solutions being put on the table to help try to bring down gas prices for American consumers. We saw just yesterday the White House issue a 60-day waiver for the Jones Act in a bid to bring down the cost to transport energy goods between U.S. ports. John, as Annmarie was reporting, we are expecting those oil executives here at the White House later today. The Interior Secretary Doug Burgum told us on Bloomberg Television last week that they have been in talks with domestic producers about building output when it comes to the shale basin. Some other potential solutions that you may have heard of that we could see discussed in the future includes asking Congress for a federal gas tax holiday and also potentially waivers when it comes to higher ethanol content gasoline.
Tyler Kendall with the latest from the White House. Tyler, thank you. This is what Edward Fishman of the Council on Foreign Relations has to say. Writes the following: Iran is waging war on the global economy. Its strategy is clear. Keep the Strait of Hormuz effectively closed until prices rise enough to force President Trump to back down. The author of Choke Points, American Power in the Age of Economic Warfare, joins us now for more. Eddie, good morning.
Good to see you, John.
Let's sell some books. Let's talk about the significance of this choke point. Who's got control of this?
Iran. I think that's the one thing we've learned, is that Iran has established very clear control over the Strait of Hormuz, and there's very little that the United States can do without committing ground forces to stop that. Trump entered the war assuming that Iran would not close the strait, because the theory was that they would have to put thousands of sea mines in the strait to close it. And if they did that, what would happen? Iran would not be able to sell its own oil, so it would be economically suicidal. Well, Iran has kind of created a new kind of economic warfare with just using cheap drones that cost, $10,000 a pop and only hitting about a dozen ships, right? They haven't hit that many ships. They've changed the risk calculus of the entire shipping industry. And so they've really created this very low-cost way of disrupting shipping, and we don't have a great answer for it.
I'm glad you brought up the cost, because these jihadi drones are $10,000 to $20,000 to produce. How many does Iran right now have in stockpile? Because how cheap they are to produce means they could potentially prolong this war for as long as possible.
I think that they could prolong this war as long as they want if we're talking about producing and using low-cost drones. They've got tens of thousands of them, but I think more to the point, the room we're sitting in right now is bigger than you would need to actually produce Shahed drones. And Iran is a huge country. I think it's the 15th or 16th largest country in the world. So even in a scenario in which we've got airstrikes for the next year and destroy every single thing in the country that looks like a military target, we're not going to be able to stop them from producing drones.
Members of Iran's parliament right now are debating potentially making it basically like we have on our transit system. You have to pay a fee in order to get through the Strait of Hormuz. So basically, is the United States at some point ceding all control of this international waterway to the regime?
Yeah, I mean, look, one of the core factors underlying American hegemony for decades has been that the United States provides open sea lanes. What Iran has shown now is that they actually control the Strait of Hormuz. And even if this war were to end without regime change, so if this war ends and Iran's decimated militarily, but you still have the IRGC in control, Iran still controls the Strait of Hormuz. And to your point, Anne-Marie, I mean, it's quite remarkable. Iran negotiating bilaterally with, not only the Indians and the Turks and the Chinese, but the French and the Italians, U.S. allies, about creating kind of like a TSA pre-check line to get through the Strait of Hormuz. I mean, talk about leverage. It's quite remarkable and not honestly anything I would have expected going into this conflict.
You said it's hard to see an out unless the U.S. makes real concessions or the U.S. sends boots on the ground. What would boots on the ground look like?
Sure. I think this is a really important point because I do really think there's a binary right here. There's sort of two ways to reopen the strait. One is you cut a deal with the Iranians in which you're making painful concessions, probably leaving, almost certainly leaving the regime in power. But beyond that, maybe drawing down some U.S. forces in the region, maybe providing some security guarantees to Iran in the form of Russian or Chinese boots on the ground, a kind of tripwire in Iran, the way that the United States has in the NATO countries. I think if you were to put boots on the ground, what would you need to do? If the goal is reopening the strait, you need two things. One, you need naval patrols in the Strait of Hormuz. The U.S. Navy has not wanted to do this because we could lose these exquisite warships just by short-range missiles or drones. But two, we would also need to occupy quite a lot of the coastal part of Iran in the Persian Gulf to get enough of a buffer zone so that it's out of range of the drones. To the point we made before, they're going to have drones, so we need to actually build a very big buffer zone to prevent them from using them against ships.
How much of a tipping point is this in terms of the Middle East's power as a financial center, as a place that's been attracting a lot of money, as sort of a new growth area that everyone wants to get into, at least until now?
I think this is one of the more tragic elements of this war, because I think in the last few years, Gulf countries have made really substantial strides to diversify away from just being commodities producers. We've seen, the UAE, Saudi really invest in the future economy, becoming sort of hubs for data infrastructure, AI, et cetera. Well, guess what? We've now seen, for the first time in wartime, a handful of AWS data centers struck by Iran. And the real question, I think, that will come out of this is, even if there is some stability, will investors feel confident putting these really important AI data centers in the Middle East? I'm not so sure. And then from the perspective of the Gulf countries, they're going to have a big reconstruction bill. I mean, all these investors who come on your show, who are they going to for LPs? It's the sovereign wealth funds of these Gulf countries. They're not going to have as much money, I think, to splurge on Western private equity funds if they're needing to invest in rebuilding the Ras Laffan, natural gas facility in Qatar.
Eddie, final question, 40 seconds. Rammer speculation. We'll be forgiving in the future because this is a super fluid situation. How do you think this ends?
Oof, well, please do forgive me. I do think that it's likelier that Trump escalates than that he caves. So I've always been skeptical that TACO applies in this scenario. TACO in a trade war, Trump can unilaterally suspend tariffs, and no one's all the wiser. Everyone says, okay, well, we won. In this, if Trump backs down militarily, he has to walk away with his tail between his legs. And we never know if Iran actually would even allow ships to go through the Strait of Hormuz.
Eddie, it's good to see you.
Good to see you, Jude.
Thanks for being here. Thank you very much. Eddie Fishman there, the Council on Foreign Relations and author of Choke Points, American Power in the Age of Economic Warfare. Coming up on the programme, we'll catch up with Samantha Dowd at Goldman Sachs as attacks on energy facilities send prices absolutely soaring. Plus, Danny, how's your morning movers? Micron's big spending plans weighing on the stock. That name is down by close to 7%. Following back-to-back gains on the S&P 500, the threat of back-to-back losses. Down yesterday, down again this morning. We're negative by 0.3 on the S&P, on the Nasdaq down by 0.4. Underperformance from the Russell. Small caps, negative 0.7. In the commodity market, Brent and WTI. Brent rallying close to 120 again overnight, 114, up by 6%. Escalation in the Middle East. WTI 97, far behind. An almost $20 gap opening up overnight. That's notable. And a conversation, not on the record, but a conversation at least about what the US would do and the threat of export controls just maybe part of the conversation this morning.
Remember back to 2022 when under President Joe Biden, there were certain export controls of liquefied natural gas at the same time that Europe was looking for that. That was something that was discussed because gas prices here were rising significantly. Could you see a repeat of that type of behavior this time around?
It's not been a great 24 hours for risk. You couple that with a hawkish Fed news conference with Chairman Powell. You've got yields at the front end of the curve, the highest since last July. 382 on twos, up by 4 or 5 basis points this morning, and 10s at the upper end of the range for the year so far, up 2 basis points, threatening to break 430, 429 so far this morning. As we count you down to the open and about a few hours away, let's get you some single names, some morning movers. Danny has more. Hey, Danny.
Hey, John. Starting with the U.S. listed shares of Ferrari this morning, dropping nearly 3% after announcing that they would be suspending deliveries to the Middle East. They will still have a few delivered via aircraft, but it's a significant paring back. The CEO of Ferrari saying they're not changing their production schedule for cars for the Middle East. They're just not getting out there at the moment. For what it's worth, the Middle East only accounting for about 5% of Ferrari deliveries in 2025. So not a significant stake, but it is a region that there's a lot of luxury spending. So that's enough to send shares lower. Elsewhere, some activist action. Elliott, according to people familiar, telling our very own Michelle Davis and Liana Baker that they are taking a stake in the maker of Invisalign. The shares align. They're up 7.3%. We don't know exactly what Elliott plans, but they do want to take actions to boost the share price. You have that reaction. The stock down nearly 67% in the past 5 years as the post-pandemic boom to make your teeth better starts to fade. And finally, Micron earnings, a blowout quarter, beats all the forecasts, and yet this is what you get, a drop of 6.9%. Because of their capital expenditures. $25 billion is what they plan for this fiscal year. They're going to increase that by another $10 billion for 2027. That's enough to spook investors and send shares lower in the pre-market, John.
Danny, thank you. What do we always say? You can learn something from the numbers and maybe a little bit more from how the market responds to them. You're learning something this morning.
Yeah, well, there are two ways to look at this. On one hand, you could say people aren't rewarding spending because they're a little bit concerned about where the funding is going to come from. You could also say that Micron has been on a tear over the past 12 months. And so ultimately people sort of wondering about whether this really gets the job done. I'm a bit confused, to be fair, so I'm curious to see what the details are here.
That stock is down in the pre-market. On our radar this morning, President Donald Trump pushing for de-escalation after a series of attacks on energy infrastructure in the Middle East. The president warning the U.S. will, quote, massively blow up the South Pars field in Tehran, strikes Qatar again. The White House weighing plans to require ships to buy U.S. government insurance before being escorted through the Strait of Hormuz. The Financial Times reporting it remains uncertain if military escorts will be made available. And finally, the Vice President, J.D. Vance, will be meeting with oil executives a little bit later on today, with oil executives discussing the move in crude. Brent close to 114 this morning after getting very close to 120, and gasoline prices getting close to $4.
Yep, exactly, $4. That is going to be a huge psychological impact on this White House. And in some states, we are already there, especially on the West Coast, and the president's own state of Florida is at 390 this morning. So this is significant. The Vice President of the United States, an individual which lots of reporting that this is an isolationist, potentially not on board with what is going on in the Middle East, will be meeting with oil executives today. So they're going to have this dialogue on what else is on the menu of this administration, what else is in the tool box for them to pull. We saw them do waivers on the Jones Act yesterday. There is discussions with this White House about potentially banning exports of products. We are a net energy exporter. And then there's one that people push back and they're like, that's not really a case. But a la 1970s, you can see this administration potentially, if things get really bad, ring fencing the United States. This is our energy. We are not going to export it, and we're going to cap prices.
Well, and this is when we saw, for example, liquefied natural gas in the wake of the 2022 war. What happened with 2024 when that happened, when the government came out and they limited some of the licenses for liquefied natural gas going over to Europe. How does this create complications with that relationship? How does that create complications for the LNG market in the U.S. that has pledged to provide extra to substitute for where Russia left off? And how does this really insulate the United States when it's not just oil and gas? It's also fertilizer. It's also helium, which potentially could be a problem for chip manufacturing. So this is a bigger issue and a question of what these oil executives can possibly do to stave off some of these rises.
Big squeeze in gas prices, particularly in Europe. Brent, the big move overnight, of course, rising close to 120 as Iran ramps up attacks on energy infrastructure in the Middle East. We caught up with Jeff Curry of Carlyle, saying markets are underpricing the supply shock.
I like to call it molecular contagion. Last week we were talking about shortages in Singapore. This week, it's in Rotterdam. This thing's going intercontinental. There's no more price spread. There's no more spare barrels. There's no policy fix, and it's just physics at this point. And I want to emphasize these are physical supply chains, and that the idea of around financialization and the ability to print money doesn't apply here.
Samantha Dowd of Goldman Sachs writes in the following: the developments underscore upside risk to our price forecast from longer Hormuz disruptions and persistent damage to energy production even after Hormuz reopens. Sam joins us now for more. Sam, good morning. Good to see you.
You too.
Let's start where we kicked off this program this morning. Brent at 115, WTI at 98, and a spread starting to open up even more. What do you think it speaks to?
So I think the market is pricing in this probability that maybe the U.S. government will restrict exports. And if you're not exporting TI to the rest of the world, then you have a bigger oversupply within the U.S. So WTI prices would stay on the low end and sort of disconnect from international prices.
Can we explore that a little bit further? What would happen if they actually introduced that policy?
So if you're blocking exports, I think the main risk, for example, especially product exports that everybody's talking about, the main risk is that the refineries in the Gulf Coast will lose those high margins they are seeing in the market right now, and they may choose, okay, I don't have the same incentive to produce that I did just a minute ago, I might reduce my production. So it's not obvious what the net impact will be in terms of product prices to the rest of the U.S., also because we don't know if other countries might retaliate. At the moment, if you look at the northeast of the U.S., it has to net import products. Same thing with the West Coast that Annmarie mentioned earlier. So it's not that easy to balance everything. Even on the crude side, yes, the U.S. produces a lot of light crude, but we import a lot of heavy crude. A lot of our refineries are set up to run a heavier type of crude. So what if other countries retaliate on exporting that to the U.S.? So it's not an obvious answer. It can lower WTI prices. It can potentially even lower product prices for the rest of the country. But we don't know what other ramifications might be. And when we saw that in the past, we saw the oil industry lobby against those types of measures. So I am curious to see where those conversations end today.
Are you saying that you think the market's wrong, that you think that this gap has to close one way or another, potentially with WTI coming up to meet Brent crude?
No, I think with these conversations happening, the market is just trying to price a probability that they go ahead with it. And I think because of the sharp spike in prices that we've seen so far, it almost puts everything on the table. And in the hopes that, okay, we produce a lot of oil, we produce a lot of products, maybe we can pull this off. So I think it's correct to price in a probability this happens. I just don't know if the outcome will be the desired one.
Are you surprised that the market, the paper market, isn't reacting more strongly to what a lot of people are saying is a real shift that we saw yesterday, where suddenly gas facilities came under attack, suddenly oil facilities came under attack, both suffering damages that could potentially take them offline for a longer period of time? Are you surprised that there isn't an even bigger reaction, not only in current futures, but also 3 months, 6 months, 12 months out?
Yes, I am. What we've seen is that your Middle East price rose up the most, and that makes sense. That's where the shock is. And when you look at Brent, not quite as much. You still see a big differential. And even in the Middle East, when you look at their physical prices, they are even higher than their financial prices. So it's almost like the market is saying, maybe this can still be a short-lived event. So you price the most your physical local market. Then second, you price your local financial market. And third, you price the financial markets elsewhere. When this is not a given today, that is going to be short-lived. In fact, the escalation that we saw over the past few hours would, I think, suggest an increased risk that this goes on for a little bit longer. So, yes, I am surprised. And I would expect the longer this goes, the more those financial prices will embed those risks in it and will go higher.
I'm glad you bring up this point. The essential closure of Strait of Hormuz is short-lived because that can reopen if there's a détente. Actually hitting energy infrastructure and long-term damage is already long-term. How long for this all to be rebuilt and the supply chains to get back to normal when actually the product itself is getting hit?
That is a key point. I like to say that there are two variables for us to watch in all this confusion. One is how much volume is out of the market. And that hasn't really changed because you're hitting infrastructure that wasn't really sending product or oil or gas through the strait to begin with. So you're not changing today what's coming out of the market. But the second variable to watch is how long this lasts. And the Strait of Hormuz, to your point, is just one part of that answer. The second part is, well, if you're destroying infrastructure, this may take longer to fix. This might not be a 4-week run-up of operations in a refinery that you chose to shut down. This might take longer. It might take a few months if you have extensive damage in some of that infrastructure. So that second variable, the risk of how long the disruption lasts, you're essentially making that risk higher. The more infrastructure gets hit, the higher the risk that disruptions last longer.
As we look ahead to J.D. Vance, the vice president, sitting down with oil executives, the United States is not a monolith. If we have an export ban control, what does this do for the West Coast that are so reliant on Asian imports for their products?
Yeah, and it's difficult to move. So you produce a lot of those products in the Gulf Coast, and it's difficult to move to the West Coast in particular because you're not going to have enough pipeline capacity to do it. So you have to ship it around, and it's not quite as easy as shipping to the East Coast. So it'll be a bit clunky. Not without friction, which means prices can still stay higher for a little bit longer.
We've seen big moves in crude, big moves in gas prices. Have you started to see anything happen in ags, in soft commodities, off the back of this?
We're definitely getting a lot of questions on it. And we also see direct headlines saying Pakistan, Bangladesh, India supply to fertilizer plants in those locations already being curtailed because they don't have enough natural gas to do it. So we were talking to our chemicals analyst in the U.S. asking, well, the U.S. still has supply. Do we have any spare capacity to fill in that gap? But the answer is, well, the U.S. has cheaper natural gas than everybody else to begin with. So we're already cranking this up as high as possible. So you don't have spare capacity to crank this up. And planting season is coming, so everybody's going to need a lot of this stuff coming soon.
When do you think we'll be confronted by that reality?
Oh, I don't think it takes long at all because already supply is being affected. The production of fertilizer is being affected and planting season is coming.
Sam, it's good to see you. It always is. Thank you. Samantha Dutt there of Goldman Sachs breaking down the commodity markets, something you've been focused on too.
I'm looking right now at corn futures and they've been on a tear. And I imagine it's a direct response because this particular fertilizer is for corn and wheat and some of the other staples that people need and rely on for their livelihoods.
Soybean farmers have been hit when it comes to China not buying as much, when it comes to the trade war and the tit for tat between Washington and Beijing, and now they're getting hit with higher fertilizer prices. This administration was talking about bailout for farmers. This is going to get incredibly contentious between the White House and the middle of America.
We'll keep track of these moves for you. Brent this morning, 115 and higher by more than 7%. Let's get you an update on news elsewhere. Your news worldwide in your Bloomberg brief. Yahya has more. Hey, Yahya.
Hi, John. The FBI is investigating former National Counterterrorism Center Director Joe Kent, who recently resigned from his position in protest of the Iran war. Sources telling us here at Bloomberg that Kent may have improperly shared classified information. The inquiry, though, has been underway for months. HSBC shares are trading lower in London, down more than 3%. Amid reports the bank is considering deep job cuts due to AI. Sources telling us here at Bloomberg the cuts could impact around 20,000 jobs, or about 10% of its total workforce. Non-client-facing roles in global service centers are among those expected to be the most impacted. And Elon Musk saying his companies SpaceX and Tesla will continue ordering NVIDIA chips at scale. Musk posting on social media he is a huge admirer of NVIDIA and its CEO Jensen Huang and thinks the company's $4 trillion valuation is well-deserved. That's your Bloomberg brief. John.
Yahya, thank you. Thanks for this morning. Up next on the program, setting up for a showdown.
I have no intention of leaving the board until the investigation is well and truly over, with transparency and finality. On the question of whether I will then continue to serve as a governor after my term ends and after the investigation is over, I have not made that decision yet.
Up next, we'll catch up with the former Fed Governor Betsy from New York City. You're watching Bloomberg TV. Central bankers confronting a shock in the Middle East. Chairman Powell first up, choosing to anchor inflation expectations in the news conference yesterday. Next up, the Bank of England about 12 minutes away, and after that, the ECB. Into that, futures softer, negative by 0.4% on the S&P and down by 0.6 on the Nasdaq. Into that, crude higher. Brent pushing closer to 120 overnight, 115 right now, up by 7%. And now you start to get a move in WTI. TI up by 2% to 98.22. Unlocking this move at the front end of the yield curve, 4 basis points higher through 380, the highest yield we've seen on a 2-year. Going back to last summer.
It's difficult for any central bank to cut rates significantly in this kind of backdrop, given the fact that inflation was already above target, was accelerating in certain corners, and then you add to an oil shock that has no clear end. And that is the reason why Fed Chair Jay Powell just threw up his hands and said, we don't know. What we're going to hear from the ECB and Bank of England could be a little bit more definitive in the wrong direction. And frankly, this bond market is repricing.
Not my circus. And it sounded like he was more concerned about inflation even before this shock, which was slightly curious.
Yeah, I wonder who he was channeling in terms of that, because the different Fed members have different views. Interesting also, 11-1, that Chris Waller got on board with the majority to hold things where they are and not signal another rate cut. Again, what changed if it wasn't necessarily some sort of strength in the labor market?
Even with that very weak jobs report just a week or so ago. Under surveillance this morning, setting up for a showdown.
If my successor is not confirmed by the end of my term as chair, I would serve as chair pro tem until he is confirmed. I have no intention of leaving the board until the investigation is well and truly over, with transparency and finality. On the question of whether I will then continue to serve as a governor after my term ends and after the investigation is over, I have not made that decision yet.
So here's the latest this morning. The Fed Chair Jay Powell vowing to stay at the central bank until the DOJ completes its investigation. The former Fed governor, Betsy, writing the following. This could turn into a real standoff. It's unclear whether it would disrupt markets or be seen as a sign of Fed independence and continuity. Betsy joins us now for more. Betsy, welcome to the program. Continuity or disruption?
For me, it's continuity, but this is something that has never happened before. So if you unpack what Jay said, the first one is that he would serve as chairman pro tem. That's the way it's always been done while waiting for a chairman to be confirmed, although it's usually for a chairman to be confirmed to a second term. So it happened with Greenspan, Bernanke, and with Powell. So that's the way it's happened, but I'm not sure that's in statute. So with this president wanting to assert control over the Federal Reserve, the president may step in and name an acting chairman of his own from the existing board, not a new appointee, but he may want to do that, and I'm not sure what the standing would be for the Fed to fight that. But the FOMC, the group that actually sets interest rates, the FOMC actually has the authority to elect its own chairman. So you could potentially see a situation where the FOMC elects Powell as chairman, but the president names someone else on the board as chairman of that board or acting chairman of that board.
So, Betsy, that sounds like a mess. And until now, there hasn't been much disruption in financial markets. Inflation expectations somewhat elevated but stable up until this shock, not disrupted by the Fed's attacks they've been under from the President of the United States. Do you see that changing in months to come?
Well, there have been a couple of times when markets got nervous when there wasn't some sort of a move on the Fed. If this breaks out into all-out confrontation, though, it is going to be concerning for markets. Now, whether that disruption in markets then cools the situation down remains to be seen.
Betsy, do you think that Fed Chair Jay Powell is putting a spotlight on this conversation or turning the volume down, given his decision or the fact that he hasn't made a decision yet, to step down as governor after his chairmanship is over?
So I think that part of the reason he made the statements he did yesterday is that some of that was in the court filings, and so in the public record, but not front and center in the Fed universe. And so it looked to me like he had that statement prepared. He read it. He was waiting for the question. Oddly enough, in this press conference, it took longer for somebody to ask him what he was going to do. But he was ready with that. And, he's basically saying he is not going to leave there as long as there is any shred of this investigation left. He left open, though, whether or not he would actually leave his seat and give the president another seat to fill. And I think that is going to just be determined by, what happens next. And but I want to be clear. I don't think his fight is with Warsh. I think he and Warsh, once Warsh is confirmed, he and Warsh will work well together. Jay has worked under Chairman Bernanke, Chairman Yellen, and he will work fine with Chairman Warsh. I don't think that's where the tension is. The tension is between the Fed and the president.
Betsy, is this really a difficult moment for the Fed just in terms of setting policy? I mean, it seems pretty clear that if they do nothing, there's really no risk on either side. So they sort of out of play anyway as this political fight takes place?
I wouldn't say out of play. I would just say there are many, many events that each and every one of them by themselves would be a single supply shock or demand shock that would work its way through. But there's been a series of them. And so, at some point you look at it and you say, okay, we've missed our target for 5 years for very good reasons in each case, but it's been 5 years. And so when do expectations become unanchored?
Betsy Duke, appreciate your time as always. Betsy Duke, they're the former Fed governor. Right now, inflation expectations haven't become unanchored.
Which is one reason why they're not considering a rate hike, right? If you start to see those five-year forward break-even rates, some of the market established views on exactly what inflation could look like, not necessarily the University of Michigan sentiment survey,
sure,
then do you get a response that is somewhat different in terms of gaming out a rate move in either direction in the remainder of this year.
We are all major advocates of central bank independence, and we all agree that the president's attacks on the institution are misplaced and undermine the ability of the Federal Reserve to reduce interest rates over time, or could. The issue I have at the moment, I keep going back to this, is that there is no evidence right now in financial markets that they've been rattled by those attacks. There is no evidence in financial markets that there has been an erosion of central bank independence. So I find it difficult to understand why the chairman thinks that he is the only defender of central bank independence, and without him, somehow this all goes awry.
If Congress is that much of a believer in the independence of the Federal Reserve, shouldn't they have a handle on this? And I think it's a fair point.
It's not your choice about who the president nominates and who the Senate confirms. And once your term's over, this is highly unusual stuff. Your term's over, someone else is confirmed, the chairman leaves. Sticking around because you don't like what's going to come next, I find very political.
We shall see. I mean, honestly, it's going to be an interesting couple of next months.
The third hour, up next.
Today, the FOMC decided to leave our policy rate unchanged.
They decided to just basically completely ignore the Middle Eastern shock that we're facing here.
They're basically saying all of this going on in the Middle East is a speed bump.
I'm not really taking the SEP or the dots very seriously.
There's not a huge amount of forecast accuracy here.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. The third hour of Bloomberg Surveillance starts right now, and your scores look like this. Futures declining by 1/3% on the S&P, down by 0.5 on the Nasdaq, negative 0.75% on the Russell. The epicenter of disruption once again in the commodity market, pushing 120 overnight, very close on Brent, back down to 113, higher by 6%. Gas prices spiking, escalation in the last 24 hours, with energy assets targeted across the Middle East and central bankers confronted with a major shock. Chairman Powell first up, anchoring inflation expectations. The Bank of England follows, leaving interest rates unchanged at a 9-0 vote, and saying this: all members stand ready to act to contain inflation, and forecasting inflation at over 3% for the month of February, near 3.5% for the month of March. And this is a problem, not just for the UK, for the ECB as well.
You know, it's notable that this was actually a unanimous decision, because usually there are dissents on the Bank of England. When you hear what the individual members have to say, it highlights just how much this oil price shock changed their view. Maybe not necessarily with a rate hike, but in terms of not cutting. The Bank of England's Lombardelli said he's prepared to act over any persistent inflation. Bank of England's man coming out and saying she would have considered a lower or even some sort of hike should this continue. Really kind of coming out with this idea that this is making them more hawkish, but not ready to act just yet. I'm curious to read into all of these decisions to figure out exactly how much they endorse the idea of a rate hike ahead.
This is the issue for so many central banks, particularly single mandate central banks like the ECB, like others that have to target the inflation rate. They're squeezed by other issues as well. For the US, you've got all these tailwinds for US economic growth coming into 2026. The rate cuts we've already seen, the fiscal stimulus coming through the pipeline, the tax refunds, the amount of tech capex we're going to see over the next 12 months. Maybe the Fed's got a cushion here to sit here and wait and watch how this plays out. The problem for the UK, the employment market's not in a great place, neither's the economy. Energy prices are going to squeeze the consumer, and you've got a Bank of England leaning into the prospect of tighter monetary policy on top of that. That's a tough place to be in.
Which is the same place that the European Central Bank is in, although in the Bank of England's case, they have an even worse situation given that they're a smaller economy and are very susceptible to these shocks. Right now, you are seeing the pound gain a little bit versus the dollar, and you are seeing about 50 basis points of rate hikes fully priced into the market for the Bank of England, as it does seem like the different members would have been dovish, would have come out with cuts had it not been for what we saw. They now have one fewer lever to pull to try to bolster this economy when they have to fight inflation. And frankly, this is going to be inflationary.
The sequencing is really off as well. You'll get this shock to inflation up front all at once, then the growth hit further down the road. And for the Federal Reserve, this is what George Goncalves of MUFG was talking about. The issue is that all shocks are initially inflationary before becoming contractionary. Going on to say, we anticipate the Fed will fall into the same trap as they did in 25 by pushing back remaining cuts into the second half. That's the problem with the sequencing.
Right now, what you look at when you check out Fed funds futures is the first rate cut is in October 2027. And then after that, a bunch more rate cuts are following, which indicates that the Fed is going to remain on hold until there is a weaker financial condition. Is that going to be the same for the Bank of England and the ECB? And as a trader, what do you do with this, given that it is circumstances well beyond any of their control?
The ECB in the next hour. Let's break down the last 24 hours. So around this time yesterday, a strike on an Iranian gas field. A report from Axios confirming it came from Israel with cooperation and approval of the United States of America. Iran vowed to retaliate. We've seen that big time overnight. And then the president steps in and denies having any knowledge of it ever happening ahead of time, and warning the Iranians that if they continue to strike assets, particularly in Qatar, he'll retaliate even harder next time. That's how messy things have become in just 24 hours.
Right. So the president is trying to distance himself from this report and even our own reporting that the United States knew Israel was going to attack South Pars, which is the biggest, largest natural gas field in the world. It's incredibly important for Iran in terms of their domestic needs as well. Now Iran is targeting. In the last 24 hours, you have seen a number of installations across the Middle East get hit. We're talking about Qatar, and the president was saying that in his Truth Social post about Qatar's LNG gas facility. This morning, on Eastern time, it was in Saudi Arabia that it was hit. So this is the escalation of the news phase. Energy infrastructure is a massive target for the regime. And as their missiles start to wind down, they don't have as many more. They are going to go for even bigger targets.
Equity futures down by 0.5% on the S&P 500. Coming up this hour, Gargi Chaudhuri of Blackrock as stocks wipe out weekly gains. Max Layton of Citi expecting oil prices to go even higher. Steve Ricchiuto of Mizuho reacting to the latest jobs data. Here's a view on Wall Street this morning as investors weigh the Fed and Middle East conflict. Gargi Chaudhuri of Blackrock writing, we're in the latter shock now, where pullbacks will likely provide opportunities in weeks and not in months. Gargi joins us now for more. Gargi, why is a pullback at this point an opportunity?
Good morning. It's good to be here. So definitely a lot of uncertainty, like Chair Powell laid out. But like we've seen, a few times before, perhaps this is a different conflict than past geopolitical shocks. But at the end of the day, whether it's in a few weeks or a month, it does always provide an opportunity to get back into the market, especially when, and I think this is the more important part that I get to in my note to you, is when the fundamentals remain solid. And I think that's the point here. Of course, this is a big shock. I think investors, rightly so, are sort of thinking about ways in which they can raise liquidity in their portfolios. But at the end of the day, in the U.S., the fundamentals are still solid and supportive. Earnings growth is still extremely positive. And real GDP, as we saw from the chair yesterday, is expected to accelerate.
You were precise with your words. In the U.S., this shock will hit different markets in different ways. Where does it leave other markets outside of the U.S.?
Absolutely. And I did say that about the U.S. because we are in a relatively better spot, obviously, given the energy export, being a net energy exporter. I think coming into the year, we were feeling quite positively on the emerging market complex. You know, I've come on your show before and talked about our fondness for emerging market equities and certain parts of emerging market debt as well. I think now we have to be a little bit more precise within that. Obviously, countries that are net energy importers, and, you know, I'm from one of them, I'm from India, and we're already at home beginning to see the impact of LNG prices and how that's impacting the consumer. So I do think there's going to be a huge amount of differentiation. Obviously, countries within the EM, and I'm looking at LATAM specifically, which are energy exporters, I think will do a lot better, especially because their exports will not be as, impacted by the crisis in the Middle East. I think we have to be a little bit more careful, certainly in Europe and emerging markets. But the U.S., at least for now, I do believe there's going to be continued pullback. But I think that it's going to be viewed as an opportunity to re-enter, especially the areas of the market where the earnings growth has been very solid. And I'll also say that, especially in the U.S., this is giving investors a chance also to diversify. I think that's one thing that clients have been asking us what to do. Where should we go for diversification? Because nothing has worked. So this is where we sort of are telling investors, listen, think about building a really diversified portfolios, which does have bonds within them, as well as U.S. equities and parts of commodity markets.
Gargi, I love this. And that's exactly where I was going to go. Diversification earlier this year was move into Europe and move into Asia. Now have we flipped the script and it's go into the U.S., but go into stocks and go into bonds and go into commodities?
Look, I think it depends a little bit on what your horizon of investment is, right? So at the end of the day, do we think this is going to impact emerging market stocks and European stocks for the next 12 to 24 months? Probably not. So those investors that are looking to build a portfolio for a very long period of time, you're absolutely supposed to have some of those international markets, especially given some of the valuations that we're getting to. And also because emerging markets, again, is another great way to get that AI value chain that we've talked about. But for those that are looking for the next, I would say month, 2 months, maybe even 6 months, I think more and more the signs are becoming quite evident that U.S. is where the continued earnings growth is, and U.S. bond markets are where, especially given some of the backup in rates, is where you're supposed to source your income. And frankly, investors are doing that. 75% of the inflows in the U.S. in the first sort of 15 days of March have been into fixed income products, not equities.
What a month of March it's been already for crude. Massive moves. Gargi, I'm just going to cut in with this breaking news. A big move in crude, a big move in gasoline prices. And this president and this administration is starting to sound a little bit more rattled. This from the Treasury Secretary speaking to the American press just moments ago. The US could do a unilateral release of oil reserves. And going on, in addition to that, saying this, the US may unsanction Iranian crude that's already on water. That's quite a line coming from the Treasury Secretary moments ago.
It feels like they understand this moment is just intolerable when it comes to what is going on in the energy landscape. So they're willing to unwind some of their key foreign policy initiatives. And that would be a gift to the regime in a sense, that we are going to unwind the sanctions we have on this regime because we want your crude, because we are so desperate. Two key headlines also saying that, look, we're also willing to go unilaterally and tap the SPR again. What other tools in the toolbox are they discussing? Well, I'm sure it's going to be key this morning when executives meet with the vice president.
One thing that they're not doing, and this is what the Treasury Secretary said, we're not intervening in oil futures. We are not going to do financial market oil intervention. So trying to quash some of that speculation that continues to circulate even after they tried to quash that before.
Secretary Doug Burgum told Joe Matthew and Tyler Kendall last week it is under discussion. He said it'll take a tremendous amount of capital. I'm not going to say more of it. To my knowledge, it hasn't happened yet, but it is under discussion. Okay, maybe it's not happening right now, but they've definitely discussed it.
Do you want to get a real move? Check out the UK right now. Get to the UK government bond market, 2-year, front end of the curve. 27 basis point move. Call it 28 at the front end of the UK curve. That's a major move, a massive move. We've got a big move stateside as well. We're at the highest level since last summer, but I'm talking mid-single digits on the session after being up 10 yesterday. You've got a central bank that needs to stay tighter for longer, even though the central bank is looking at an economy that's not doing well right now because of one thing, the shock that's coming from the Middle East. And this is the second one we've seen. You've had the Federal Reserve leading to anchoring inflation expectations, the Bank of England doing the same, and in 1 hour from now, you might get the ECB doing exactly the same thing as well.
Just to give you a sense of perspective around this Bank of England decision, this was the first time of the Bank of England that all 9 members had a unanimous decision in 4.5 years. They have not agreed on anything. And what a lot of even the more dovish members said was they would have voted for a cut had it not been for what is going on in the Middle East. Even those that are more hawkish and now even more so, and talking about the potential for hikes. The market's clearly reacting, 50 basis points of rate hikes getting priced in. This is a very difficult situation for all European central bankers.
Gargi, I'm working through this in real time. I keep going back to this. We've repriced energy, big move. We've repriced rates. We've taken easing out and priced in hikes in places like the Bank of England and over at the ECB in the Eurozone. Do you think we've repriced growth sufficiently off the back of those two things?
You know, I think there's so many drivers of growth in the U.S. I think that yesterday what we heard from Chair Powell, it was actually quite surprising to me to see how much they'd revised up their forecast for growth. But I think the message that the market heard was that productivity greater than oil, right? That was what they were saying, that the impact of productivity is what's driving growth. I do want to point out that, especially since you're talking about BOE and ECB, us having a central bank that has a dual mandate does make us different, right? I don't know that we're going to be at a point where we're going to hike interest rates as a result of this, because what we're not talking about is the demand shock. The demand shock that, you know, may come if prices continue to be here. And in that case, we're far away from hiking, given that it's a dual mandate central bank. We're more likely to focus on the growth shock and therefore on easing policy rates. So even though markets are repricing the front end pretty aggressively, I wonder if, you know, we're forgetting that this is a central bank that's more likely to ease if growth shock comes into the picture. Having said that, I think productivity, which has been immense, is what's driving some of the growth forecasts from the Fed, much more so than oil.
Gargi, good to see you. As always, Gargi Chaudhuri there of Blackrock, breaking down these moves. We've had a 40% plus move in crude for the month of March so far. That's WTI. Brent, an even bigger move, plus this morning. And you've got a major move in gas prices in Europe as well. And this is what rates traders are doing with it. We're now pricing over at the Bank of England a 50% chance of 3 hikes this year, 2026. Only a month or so ago, we were talking about the prospect of rate cuts over at the Bank of England. That story has flipped and turned around aggressively.
And it's because it's a single mandate central bank, just like the Bank of England. You've seen in the past, when there has been a more hawkish projection from some of these central banks, the currency loses value. That's not the case today, but I am watching that closely because ultimately this will crimp growth potential going forward, and that I clearly see as a concern.
So big moves here in the last hour or so. Let's get you an update on news worldwide with your Bloomberg brief. Yahya has more. Hey, Yahya.
Hi, John. President Donald Trump pushing for a de-escalation of attacks on Middle East energy assets. The announcement's coming after Iranian and Israeli strikes on major gas fields. The president saying any additional attacks by Iran on Qatar's LNG facilities would prompt the U.S. to, quote, massively blow up the entirety of the South Pars gas field. Eli Lilly's experimental weight loss shot seeing major success in its latest trial. The GLP-1 helped diabetic patients lose over 15% of their body weight, more than any other drug currently on the market. Lilly sees it as an option for people with more severe obesity who may need a stronger treatment than the company's Zepbound shot or Novo Nordisk's Wegovy. And we are seeing Rivian shares soaring in the pre-market, up more than 10%. Uber announcing a major investment into the EV maker as it ramps up its push into robo-taxis. Uber will purchase 10,000 Rivian models to be used as robo-taxis, part of a $1.25 billion overall investment. Rivian robo-taxi rides will be offered in San Francisco and Miami by 2028, with plans to reach 25 cities globally by 2031. That's your Bloomberg Brief. John.
Yahya, thank you. Thanks for the update. Up next on the programme, we'll get the reaction from Max Layton of Citi, looking for some big moves in energy. We've had them already overnight. His thoughts in just a moment, and the latest headlines coming out of central bankers worldwide. From New York City, you're watching Bloomberg TV. Let's break it down. Equity futures near session lows were down by 0.5% on the S&P, negative by 0.9 on the Russell. In the commodity market, Brent overnight close to 120. This morning, right here, right now, 114, up by 6%. In the bond market, let's just focus on the very front end of the yield curve, stateside, and then we'll move things worldwide. The 2-year in the US pushing 390, up 10 basis points yesterday, up close to 10 this morning, 387. The chairman of the Federal Reserve anchoring inflation expectations in the news conference yesterday, pricing out easing over at the Fed has been the story of the past 2 or 3 weeks. In the UK, look at this right now. The Bank of England keeping interest rates unchanged and doing almost exactly the same thing the chairman Powell did in the news conference yesterday, looking to anchor inflation expectations. A 30 basis point move plus on the front end of the UK yield curve right now. This is tighter financial conditions coming out of central banks. And this isn't the final act of today. You've got the ECB in less than 1 hour's time.
To me, the fact that this was the first unanimous decision on the Bank of England going back 4.5 years highlights the paralysis that people have. Bank of England's Catherine Mann saying she is now considering a longer hold or even a hike ahead after otherwise potentially voting for a cut. It just shows how much the tide shifted.
And then you've got these headlines coming out of the Treasury Secretary, Scott Bessent, speaking just moments ago. Keep up with this. Bear with us. 1. We're not going to do anything in financial markets to intervene with oil. OK, speculation as to whether they are or not. We can let that go. The US could do a unilateral release of oil reserves to support the supply of crude. The US may unsanction Iranian oil that's on water. That's controversial, given the sanctions on Russia and Iran. And then this. Will Sea of Karg, key island, a key energy asset of Iran, all the exports come out of that island. We'll see if Karg is eventually a US asset. That headline coming from the Treasury Secretary to the American press just moments ago.
My mind is spinning because it's Secretary Bessent that's delivering that message and not the DOD head, Pete Hegseth, who's also speaking right now with Chairman Kane at the Pentagon. Now, there is this amphibious assault ship from the U.S. Navy, USS Tripoli. It went past the Chinese Strait, the South China Sea, and it was spotted near Singapore. It is going to Iran. And there's been tons of speculation. What is the president going to do with these 2,200 Marines? Potentially, could he go on and take over the energy infrastructure on Karg Island? Well, the Treasury Secretary just opened that door.
Let's stick with our top story. Crude with a big move, surging past 116 earlier on this morning, pushing 120, with major energy assets across the Middle East taking hits. Max Layton of Citi writing, our refreshed base case is that oil flows are disrupted for the next 4 to 6 weeks. We estimate that Brent prices will rally as the conflict continues over the coming days to 110 to 120 a barrel. Max is jumping on the phone for us to break down some of these headlines. Max, welcome to the programme. Very close to those levels already. What's your reaction to what we're hearing so far this morning?
Yeah, great to be on the show. So when we published it, to be fair, it was $102. So it's moving quickly. And I think the point of the report is that we need to see higher prices that bring us to either a diplomatic or a military solution to this issue. The loss of the flows through the Hormuz Strait is just so big that it can't go on. And that's why the base case is it lasts for 4 to 6 weeks. It's not because there's an obvious solution or an obvious ending. It's because when we look at the fact that at the start of the year, we were spending as a global populace around $2.5 trillion on crude oil and products. And today, annualized, we're spending more like $4.5 trillion. So this $2 trillion delta is that shift is almost as big as the first oil shock in the early 1970s. If this continues to the end of June, this kind of disruption that we're seeing, and this includes some, conservative assumptions about east-west pipelines and other diversions. So we're not even assuming, the worst case, which is that the Bab el-Mandeb Strait is affected. If this continues through the end of June, our analysis points to the prices getting back to the second oil shock peaks, not the first oil shock, the second oil shock. And that will take the spend on crude oil and products globally up towards the, you're talking 8 trillion, 8% of GDP. So it just can't, it needs to find a solution, and the market is trying to do that.
So, Max, when we spoke to Jeff Curry of Carlyle, and it's great to do this with you in real time as we get these breaking headlines, he was talking about the inverse of what we saw in the pandemic, that we had a massive shock to demand. Demand crashed, and what you needed to rebalance the market was for prices to drop aggressively lower. Now we look at the mirror image of that situation, and you need much higher prices to rebalance the oil market. Max, can you talk us through the economics of this? People band around the term demand destruction. Just what is the price elasticity of demand for energy? How simple is it?
Well, in some of the markets, we're already moving to kill demand, and you can see it in jet fuel, in some regions, in diesel. You're already trading well over $200 a barrel in those markets, and that's partly because the inventories there are more expensive to hold, so we just don't hold as high a level of them. So some countries are kind of running out of jet fuel already. So the demand destruction happens physically. The other way it happens is, just with higher prices, so people change their behavior. And I mean, we're already seeing this, certainly in the jet fuel market. This is most obvious, but I would like to make a comparison to the COVID period, because one of the big questions is a different one to Jeff's, and I used to work with Jeff at Goldman, so we go back, and I'd make a lot of people ask me, why are risk assets holding up relatively well, considering that this shock to oil supply is bigger than what happened in the first and second oil shocks. And one comparison I'd like to make is, I still remember it was late January 2020 when COVID was kind of spreading in China, and it had just reached Milan, and equity markets didn't sell off for a whole month. There was a whole month where even the Prime Minister was still going into Parliament here in the UK, and people want to believe that it's going to get better, and I think there is still, certainly in our base case, the hope that happens. But every day that passes is a day where you get closer to people kind of, the realization day that this is a really big shock.
I think you said that when you say your base case is a hope right now, Max. I don't want to really glean into the future too much, but the Treasury Secretary opened that door. I'm still struck by this headline. We'll see if Carg is eventually becoming a U.S. asset. What would that mean to energy prices if the United States takes over Carg Island?
Sure. So one of the big fears, and we put a bull case of 30% probability on the bull case. So the base case, we have 50%, but the 30% is that either the Hormuz Strait is disrupted for the next 2 to 3 months, or you get energy infrastructure attacks in the region that disrupt energy production, oil production specifically, for a period equal to or longer to what we saw during the second oil shock, which was around 6 months. And that's entirely possible. A barrage of missiles from Iran targeting one asset will be hard to stop. And it takes you, we don't know how long, it depends on the damage, but it could be 3 months, 6 months, 12 months, however long it takes you to rebuild that production capacity. So the Hormuz Strait, if it opens, can come, the oil supply can come back really quickly. But obviously, if you hit energy infrastructure, and that may be the response of Iran to affecting its energy supplies, then obviously it takes a long time to rebuild that.
Max, I just want to break down some of the other headlines as well. Bramo, that one is controversial, without a doubt, on Carg Island, and there is some speculation as to what's going to happen there in the next number of weeks. But we've already had waivers for Russian crude. And we talked about how this effort is undermining foreign policy objectives elsewhere, particularly for the Europeans, given the war taking place right now between Russia and Ukraine. The fact that the US may unsanction Iranian crude that's on water right now is also really difficult to get your head around. Think about the two conflicts at the moment. You've got the Ukraine at war with Russia, and the Europeans are still buying Russian energy. And you've got a war between the US and Iran, and the US is talking about unsanctioning Iranian crude for them to sell to the rest of the world at a higher price. Try and get your head around some of the things happening right now in the commodity market.
It really highlights the dissonance between the public response to higher oil prices, the lack of preparation to have alternative sources of fuel in a whole host of different regions, and frankly, I don't want to say panic, but a little bit of a more urgent feel coming from different administrations saying we have to do something even if it runs counter to our goals. It just raises the specter of what else do they have in their arsenal, given the fact that, yeah, you can do unilateral SPR releases. Sure, you can unsanction oil. That isn't going to unclog the Strait of Hormuz, and it's not going to solve the ultimate problem.
If they decide to unsanction Iranian oil, this would be a reversal of their own maximum pressure campaign that Trump has spoken about in Trump 1, and he went ahead and put the policy on the table, as well as in Trump 2. And the regime would be getting oil profit, petrodollars, at a much higher price right now, where you look at where Oman and Dubai crude is. I'm not talking about Brent oil, $110. We're talking about $150, $160, $170 a barrel. So basically paying the regime while at the same time the Israelis are decimating them. It's a little confusing.
Hey, Max, it's always good to get you on the phone and catch up with you in real time off the back of this breaking news. Thanks for making time for us. Max Layton there of Citi, breaking down his views on this oil market. I've got some good news, some better news, and this is the difference between the United States and the UK right now. In the UK, squeezed by energy, at the same time as the labour market is weak and a central bank is on pause, worried about anchoring inflation expectations, and two-year yields are absolutely surging. In the US, the good news, the labour market, jobless claims at 205. Initial jobless claims, Bramo, that is good news.
Yeah, and this is really highlights the data we've been getting significantly from the United States, which is the economy is still okay and people are still able to spend. I am really interested to see how much the U.S. market is moving in response to the U.K. and how much the ECB expectation is moving in tandem with what we saw from the Bank of England. What you're seeing right now, no rate cuts until October 2027 in the United States. And then once they start cutting rates, they're going to cut rates quickly. And that gives you a sense of just how much growth could get curtailed. So, yes, things look fine now. But the longer that the Fed remains on hold and the longer that oil prices really cannibalize from people's spending power, there is going to be a hit on the other side. At least that is the implication for markets.
Market's really pushing this. Two-year stateside. We were talking about it earlier. A two-year at 390 is trading above the upper end of the range on Fed funds right now. And over at the Federal Reserve, there's a tremendously high bar to hike interest rates. So think about what we're really pushing in the market right now, up by 15 on twos. And check out the UK curve. Keep going back to it. 30 basis point move. This is EM type stuff. It really is. 30 basis point move plus on the UK curve right now at the very front end, following this decision from the central bank to keep rates unchanged and anchor inflation expectations, with inflation set to come in much hotter than expected for the next few months.
Yeah, their message was pretty clear, which is ultimately they're either going to hold or hike rates. The fact that right now we're pricing in 3 rate hikes for the European Central Bank at a time when we still see growth potentially falling off as a result of this oil shock gives you a sense of just what a quagmire they're in. The fact that the U.S. market is following in tandem also shows the global nature of this bond market. Does the Fed still have control over the story?
To recap, Bramo, and we've done this so many times over the past few weeks, we've repriced energy pretty aggressively. We've repriced rates pretty aggressively. Have we repriced growth sufficiently? And I'm not just talking about the US. I'm thinking more about Europe, Asia. Have we really priced down the hit to growth that we could see off the back of these moves?
The answer is definitively not at all. And most people do not have recession anywhere in their base case. When you start to look at this type of shock, and it harkens back to the 1970s or even the pandemic type of era, those were typically recessionary. And you start to wonder, what is the arsenal that people have to really counter that? No one wants to go there because they want to believe that this is temporary, and we all want to believe that. And until there is really a sense of exactly how long this could go on, that's when you're going to start to see it breaking.
Officials are being squeezed right now. We heard from the Treasury Secretary moments ago. Want to break down those headlines with Tyler Kendall. She's got more. Hey, Tyler.
Yeah, hey, John. Well, some new ideas being floated by the Treasury Secretary Scott Bessent in this interview as this White House plays defense when it comes to their plans to help combat rising oil prices after the escalation in attacks on energy infrastructure that we saw overnight. Now, as you've already outlined, the U.S. Treasury Secretary saying that the U.S. could, quote, unsanction Iranian oil that is already floating at sea. We have to keep in mind the administration has defended similar moves when it comes to Russian barrels floating at sea, often saying that that would only be a temporary move. The Treasury Secretary also saying that we could see another tapping of the Strategic Petroleum Reserve after this 172 million barrel release that's set to take place over the next 4 months. Just for context here, the SPR currently sits at about 60% capacity amid concerns about refilling it back up. Now, of course, the priority for the White House in this conflict is getting the Strait of Hormuz reopened. And you mentioned that headline from Scott Bessent there seeming to indicate that Carg Island could still be a legitimate target after President Trump tried to scale back and de-escalate, as we've seen these targets on energy infrastructure. I want to point out that right now there is a Pentagon briefing that is ongoing, and we heard from the Joint Chiefs of Staff Dan Kane, who made it a point to reiterate that the U.S. only hit military targets on Carg Island last Friday. Bessent also here appearing to perhaps pressure the Japanese prime minister ahead of her visit to the White House here today, touting how Japan has a lot of these mine-sweeping capabilities that could ultimately help to secure the Strait of Hormuz. He also did defend the U.S.'s decision to delay that planned summit between President Trump and Chinese President Xi Jinping, saying that it is only due to logistics and not because of China's refusal to help secure the strait. John, I did catch up with the U.S. Trade Representative Jamieson Greer yesterday, who reiterated that to me, but also said that U.S. negotiators made it clear to Beijing that it is in their best interest if they help to secure the Strait of Hormuz.
Tyler Kenner with the latest outside of the White House. Tyler, thank you. Appreciate it. Crude close to triple digits on TI. Brent crude 113. Major moves over the past few weeks. Gasoline prices pushing $4 a gallon now. That will get your attention in the White House. And the White House and the Treasury, just on the margin, starting to sound a little bit more rattled so far this morning.
Absolutely. 3 huge headlines. They're going to potentially hit the SPR one more time. They're going to unsanction, potentially, Iranian crude. Remember, Trump's big thing with Iran has been maximum pressure, not a single barrel. All the flows right now go to China. So they're basically saying that maybe some of these flows can go to, say, Europe, which historically, at some point, you have European refiners that took in some of this heavy crude from Iran. This would be counterintuitive to their entire maximum pressure campaign. The regime would be making more money because right now how expensive crude is. And then this third headline that I'm still struggling to understand, because we have the chairman of Joint Chiefs of Staff, Kane, speaking, and the head of the Pentagon, the defense secretary, Pete Hegseth, speaking. And this headline did not come from them in terms of potentially the U.S. controlling Carg Island. It came from the Treasury Secretary.
It's an odd one, isn't it?
At the same time, everyone in the national security space has been tracking the USS Tripoli. Came from China. It was the other day seen past Singapore. These Marines, what are they going to be used for? Everyone's been talking about potentially they could be used for this. And the Treasury Secretary basically just said it out loud.
The energy shock is turning into a rate shock. We could talk about the move in the UK, the 2-year up by more than 30 basis points so far. The US move I find slightly more curious, and I think there'll be some pushback, particularly from people in fixed income this morning, because that rate on the 2-year now is trading above Fed funds in the upper range of Fed funds, and the bar for hikes is so high at the Federal Reserve. You'll get a few people in fixed income raising questions about just how far that should be going.
Yeah, raising questions by buying the 2-year because they'll think that people are misreading exactly what's going on globally. This is a Fed that told you yesterday that a rate hike was not anywhere in a base case or even a possible case for 2026.
Jobless claims crossed just moments ago. Mike McKee's with us for more. Mike, we've got some good news, at least on the labour market front.
Some good news on the labor market front, just 205,000 jobless claims last week, as you pointed out. So the low hire, low fire economy continues. And Jay Powell suggested that the labor market might be in better shape than we think at this point because the unemployment rate's not moving a lot. We did see the Philadelphia Fed index come out much stronger than expected at 18.1, up from 16.3. The expectation was it was going to be cut in half to just 8.0. However, prices paid rise to 44.7 from 38.9. This may be a sign that the first price effects of the war are starting to bleed into the U.S. economy. Generally, new orders fell. It was shipments that pushed up the Philly Fed numbers. So, again, that's a rearview mirror number, but the prices paid and prices received numbers may be giving us a little glimpse into what the future is going to hold.
Mike McKee breaking down the numbers. This is boring stuff, and boring's good news. Right now, the labour market's doing OK, at least when you look at jobless claims.
Yeah, at least it doesn't create a stagflationary type of environment. And for that reason, that's why people are going into U.S. equities and to some degree U.S. bonds, because the quagmire is less severe than, say, what you're seeing over in England and at the ECB.
Steve Ricchiuto of Mizuho joins us around the table. Steve, good morning. Good to see you. Big moves in rates this morning. Yields at the front end of the curve, central banks anchoring inflation expectations. What do you make of what you've seen so far?
Well, I think that the conversation you two were having before about the eventuality of people coming in and buying yield is real. We've seen this, development take place over and over again since we had the whole blow-up that took place in 2019 in the marketplace, and people are conditioned to do that. As people focus in on the oil situation, however, that tends to mute a little bit of it. But I think when you look at real risk assets, you look at corporate bonds, you look at the way spreads have come in, you look at the way deals have come into the marketplace, and we've kind of had a little bit of lull in deals yesterday and probably a little bit low today because of the volatility that's taking place. There's still a lot of liquidity. There's a lot of people grabbing duration, and that's the thing we've noticed about the corporate bond space is the longer duration assets have done, liabilities that have been sold have done better than the front end assets because people are grabbing yield. They're looking at this environment, said we've seen this before. We're going to buy yield again every time we've done it. It's been a knee-jerk response. We've done well on it, and I think that story has not changed yet. I think the market has to realize once that breaks before we'll get up to the 460 level. This may be the environment in which it happens, but I think you have to break equities through 6,500 to have that happen.
Well, I guess that this is really the key question, and we've been talking about it a lot around this table, this idea that if you have benchmark rates that are higher, if you have a Fed that's not going to cut rates, I know you never thought that the Fed was going to cut rates, but now they're doing it for perhaps the wrong reason, and you have a concern about how long this could go, do you think that people are sufficiently pricing in the hit to growth that could potentially come on the heels of this?
Well, the hit to global growth, which I think you were talking about earlier, Jonathan, is a real issue, and that just creates more of the excess supply situation. But by the same time, it also lowers the demand for energy. So that then has an offsetting effect in terms of the price of energy. So you have to consider the way these things roll through the system. It'll also have an effect in terms of the longer-term interest rate environment. It'll have an effect on, what monetary policy needs to do around the world. So, yeah, there are short-term impacts, but there are also longer-term impacts that these central bankers have to consider. And I think, none of these things are just simple one-off transactions. There's multiple layers. You have to peel back the onion to really get to the core to see what's going on. And I think when you do that, you'll come to a situation that says, demand gets destroyed. Well, then energy prices come down because there's less demand for energy. If energy prices come down, then the inflation fear is concerned. If energy prices come, the products come down, then the distribution of income changes. Then people go back to spending, and you kind of moderate things out for a while.
Let's make it more simple. You've been bullish for a while. You've seen the potential to surprise to the upside in terms of growth and inflation heading into this oil price shock.
Correct.
Are you still bullish on the economic outlook, or are you getting more concerned?
Well, of course, you've got to get more concerned. But what we've done is we've taken our right tail risk out of our growth forecast. So we're at 2.7% Q4 over Q4, which is one of the stronger numbers on the street, if not the strongest number on the street. And what we've really were saying is that the right tail risk has come off. We don't see the energy story having the same impact as the near-term impact on refund check distribution. And if you notice, refunds are starting to pick up. We're about $18 billion higher than we were at this time last year. We think we can easily get to $100 to $150 billion worth of refunds being distributed between now and the end of May, extra refunds being distributed now to the end of May. And I think that provides a good deal of near-term support to the economy. Then as we lose that, we start to get the interest rate impact from last year's rate cuts, which then help offset. Now, the energy story, yes, is, Jonathan pointed out where gasoline prices go, start to seep into the system. But again, people have ways of redistributing how they spend money. And that becomes part of the issue. I mean, one thing is instead of taking a longer road trip this summer, if energy prices are here, you take a shorter road trip this summer. You know, people have a way of adjusting themselves to relative prices. And I think those are the kind of things that economists tend not to really take into consideration.
Steve, can I ask you about these metal moves? Aluminum down by 7%, base metals getting beaten up, copper down by 4%, precious metals too, silver's down by 10%. Gold's down by close to 5%. What do you make of that?
That's the global growth impact. This is a serious impact. When you look at the original energy price stories in the 1970s, we were the least well prepared. Okay, most of Europe was modern electrified plant. They were dealing with nuclear power. We were old steam generation pre-war plant. So 25% of America's capacity went obsolete overnight. Okay, and that's what helped create the stagflation environment. And it was happening in a world of excess demand for tradable goods. As the baby boom population was just moving into the labor force, productivity was going down. Now it's just the opposite story. Europe is in the weaker space. Asia is in the weaker space in their dependence on the energy. We have energy. We're not dealing with as much of a supply shock. We're dealing with a price shock. And that's the thing. In the 70s, we were dealing with a supply shock. Okay, I lived 50 miles from my school, and I had to drive back and forth each day, and my car had a 10-gallon tank and 10 miles to the gallon. So I had to fill up every day. On an odd-even system, I'm changing license plates every morning, getting up at 4 in the morning to get on a gas line so I could get to school for 9 o'clock, okay? And this is what I was doing every single day. You would go through gas stations. There were yellow, green, and red flags. Red, you had no fuel. Yellow, you could fill up for $3 to $5, and green, you could fill up your car. So, I mean, this is the stuff that was going on back then that's very different today. Supply is available. You're paying a different price, which means it's a relative price story.
Steve, it's good to see you.
Cheers.
Thank you, sir. Thank you very much. Steve Ricchiuto there of Mizuho. We keep going back to it. We've had the energy shock. We're seeing a rate shock. Is the growth shock up next?
Yeah, I was listening to Jimmy Carter's Malaise speech yesterday because that's what I was harkening back to.
See how Abramowicz spends her time?
And I was just really struck by what Steve was talking about, changing license plates. Take the bus, carpool. It doesn't go over well with the American people. It didn't go over well in 1979. And frankly, it's not going to go over well this time. We are a long way from some of the prices that would really be concerning, but the pace of moves, just absolutely stunning.
Put on a sweater is never a good message, is it?
Put a coat on.
Or an odd or even license plate.
Yeah.
My dad just went through this with me. He was telling me all about it, how, you know, if you had multiple cars, you would be switching license plates. Headache.
This could be a tough moment. Let's give you an update on everything we've heard in the last hour or so. With your Bloomberg brief, Yahya has more. Hey, Yahya.
Hi, John. We are seeing oil prices coming off their highs for the day on comments from the U.S. Treasury Secretary Scott Bessent saying the U.S. could do a unilateral release of the Strategic Petroleum Reserve. He also said the U.S. may unsanction Iranian oil that is already floating on water and that Karg Island maybe eventually become a U.S. asset. Meanwhile, we are seeing the pound rising and yields on two-year gilts surging. The Bank of England voting unanimously to keep interest rates on hold and saying it stands ready to act to tackle any inflation surge triggered by the war in the Middle East. Traders fully pricing in 3/4-point rate hikes by the end of the year. And recapping that data we just got, jobless claims coming in at 205,000 for last week. That's 8,000 less than the previous week, and that saw 213,000 claims. Continuing claims rose to 1.86 million, slightly more than the previous week. That's your Bloomberg brief. John.
Yahya, thank you. Thanks for the update. Up next, we'll talk bonds and this big move in yields. Ian Lincoln of BMO, as traders no longer price in a Fed rate cut for 2026. From New York City, you're watching Bloomberg TV. One of those crazy mornings. Let's get to it. Let's unpack this price action together and start with stocks. Equity futures down by 0.7% on the S&P. Underperformance on the Russell, small caps negative by more than 1 percentage point. The bigger relative underperformance, though, is coming elsewhere. It's coming from Europe. Look at these moves, aggressively lower. The DAX is down by close to 3%. The Euro Stoxx 50 off by 2.5%. And there's a reason for that. Look at these two prices, WTI versus Brent. Earlier on this morning, we're opening up a gap as wide as $20. WTI right now is at 97. We spoke to Samantha Down at Goldman earlier on this morning. And she suggested that maybe there's some speculation here about export controls coming into this market, but also highlighted that none of that is straightforward. So you've got WTI at about 97, up by 0.6. Brent up by 5, just off session highs at 113. And the Treasury Secretary in the press this morning, speaking to the media, that we may unsanction Iranian crude that's on water. That is highly controversial. It's sanctioned. Russian crude is sanctioned too, but they've issued waivers for some of that. And now the speculation may be that they're going to do the same thing with Iran. OK, so that's your picture of crude. As if the energy shock wasn't enough. Now we've got a rate shock. Look at this move. Treasury yields at the front end of the curve, up 10 basis points yesterday, up by 12 this morning. That is nothing compared to this in the UK. We've had the Federal Reserve and Chairman Powell anchoring inflation expectations. The Bank of England doing exactly the same thing in a market that's pricing in interest rate hikes, not just in the UK, but in Europe too. A 37 basis point move in the UK, not on the year, not on the month or the week, on the session. Twos at 450.
Yeah, this idea that suddenly you have a Bank of England that needs to combat inflation first and foremost, sending dovish members into a hiking posture, highlights how much the tables have turned, how much things have changed in the Bank of England, and frankly for the ECB, where we now have 3 rate hikes priced in for the remainder of this year.
Ian Lingo of BMO joins us now for more. Ian, good morning.
Good morning.
What a morning, sir. What do you make of these moves, and do you think we're overdoing it at the front end of the US curve?
So I think that the U.S. is in a specific situation since the Fed has a dual mandate, and we were already uncertain about the labor market going into this series of events. Europe, the UK, that makes more sense given how we would expect monetary policymakers to react there. I do think that it is not the type of move to jump in front of, because there's so much uncertainty associated with what's going on in the Middle East and how that's going to continue to play through to the energy sector. We could get $125, $130 a barrel oil very easily if this continues to unfold in a scale that is measured in months, not weeks, as it was originally intended.
I'm struck by the yield curve, which is rapidly compressing, rapidly narrowing. People are expecting that higher front-end yields are going to send growth substantially lower, and perhaps even more so in the Euro region. How much confidence do you have that that is the correct move, that there is going to be a move much lower, say in 2027, in response to holding rates higher, whether it's hiking or whether it's just a hold?
I think that a flatter curve in this environment makes sense. I think 10 and 30 years should outperform, because if the Fed does fight inflation, delays rate cuts, then we should see break-evens compress over time and nominal rates slip lower. What I'm worried about is I'm worried about the fact that we haven't fully integrated what happens to demand in this situation. What happens to the fact that we have higher prices at the pump that leads to consumers needing to make some hard choices, and we could see consumers under a lot of stress over the next several quarters, which undermines the strong growth argument in the U.S., which has kind of defined us for the last couple of years.
So, Ian, when you put this shock together, is it bullish or bearish for fixed income, for bonds, for treasuries?
I think it's long-term bullish for treasuries. Lower rates remains my base case. I think 10-year yields are below 4% by the end of the year. And I think that the 2-year sector is going to continue to struggle.
Super volatile at the front end of the curve right now. Major moves, 30 basis points plus in the UK, double digits in the US, and you're starting to see it in growth. This move in base metals, and I keep going back to it, aluminum down by 7, copper down by 5, precious metals providing you no relief whatsoever this morning. Gold down by 5, silver down by 11.
Yeah, gold and silver, put them aside for a second. The aluminum and copper moves, directly speaking to what Ian Lingon's talking about, which is demand destruction. And the idea that people are starting to comprehend what that looks like as they hit to global growth looks increasingly likely. I just wonder how long this can go on before people have to start talking about other ways that this feeds through to the market, including in the U.S. I mean, we have this whole idea that data centers are going to save us. How do you build them if you don't have access to a lot of the materials? How do you build them if you don't have easy access to the energy prices? So there are a lot of questions here around, frankly, the bull case for all markets, global markets in particular, going into this year.
In 20 minutes' time, there's an ECB interest rate decision.
Good luck.
In the next hour, there's a news conference with Christine Lagarde of the European Central Bank. Is she going to follow what we heard from the chairman yesterday, from the Bank of England this morning? And if she does, What does it mean for this market? Ian Lingan, thank you, sir. Ian Lingan there of BMO. Tomorrow, full reaction for you. John Stolfus, Oppenheimer, Michael Zies of Morgan Stanley, Lotfi Karui of PIMCO, Jonathan Golub of Seaport. From New York City this morning, good morning. This was Bloomberg Surveillance.